2016, where we're going to be discussing the Bureau of Asset Management budget and our asset allocation. Just two, thank you so much, Chris, like, yeah, so be careful. Just two points of privilege before we call the roll. First is I'd like to welcome to the NYCERS board the new designee of the borough president of Queens, Angelina Martinez Rubio. Welcome.
Hi, nice to meet you.
And secondly, I'd like to wish a very happy birthday to Larry Schimmel from the Public Advocates Office, who kindly consented to attend even on his birthday.
Happy birthday. Of course. Happy birthday.
They told me it was not working. No, I think it's working. Okay, thanks.
Okay,
Okay, Chair. Control's Office.
John Joseph, the Control Style and Stream.
Public Advocate's Office.
Here.
Borough President Manhattan. Borough President Brooklyn.
Present.
Borough President Queens. Here. Borough President Staten Island.
Present.
Borough President Bronx. National Bucket Teamsters. Here. Transport Workers Union.
Here.
District Council 37.
Here.
Thank you very much. Okay, it's my understanding that the Controller's Office would like to start with discussion of the budget, and then we'll move from there into the aspects.
Sure. Thank you very much, Mr. Chairman. You should have in front of you one piece of paper with the budget numbers on it. Such as being handed out now. Let me introduce this. This is an informal disclosure. You guys had asked to see kind of where we stood. Well, we promised to come and talk to you formally in March about the budget. As you know, there are many moving pieces. We've been trying to fill vacancies. We changed our salary structure. We are in the process of doing many things to strengthen the Bureau of Asset Management. Many of those things were pointed out in the Funston report, which was released a couple weeks ago. In March, I'll also go through the major items in the Funston report through the lens of our strategic plan for the next 2 years. And I'll, at that time, talk about the budget implications for the Bureau of Asset Management. What I've done today is to give you a look at two things. One is the fiscal year 2015 billing to the systems. This is just the corpus funding. This is only a portion of the Controller's Office budget. That portion that is paid for by the corpus of the pension funds. And as you can see in the left column, as of 6/30/2015, for the fiscal year ending that date, on 6/30, our head count at the Bureau of Asset Management for corpus employees was 41 employees. The personal services associated with that billed in the fiscal year was $4.1 million. Now remember, during the course of the year, the head count would have changed, and so it's not always a full run rate for those 41 employees. You add on fringe benefits at 48.1%. You come to a total of $6.1 million for personal services. And then other than personal services, billed the corpus for the fiscal year is $189,000 for a total of $6.3 million. That's the history. I thought that, and then you have the NYCERS share, which is about a third, and that's what you get on your invoices. I thought it would be helpful for you not to have a forecast of exactly what it'll be the quarter, but in order to monitor our progress, to understand what the run rate was. So if you look at the employees that we have today and the associated expenses with those employees and the jobs that have been posted, so that we're actually actively out recruiting. You come up to a total of 53 employees, and on a full run rate, having those employees for a full year, we would run an expense for personal services of $7.2 million, fringe of 3.4 for a total of 10.7, and other than personal services of 482. Now remember, through 6/30, we were on the old salary rates. There was a couple $1 million of increased salary that came with the big change in salary for investment personnel. So that's a big part of the bump. The other part is the people that we're hiring, and the fact that when you look at the mix of employees, we've been hiring more senior folks than the folks that have been leaving us. So that gives you just a quick idea of where we are on a run rate basis. We'll come back in March with a more fulsome presentation and give you a more thorough idea of what it looks like for the year ahead. We're making a lot of progress on hiring. We have just 7 open positions today. We've worked those down. We've recently had a couple of acceptances in private equities, in real estate. We have serious candidates in infrastructure and in opportunistic fixed income. Things are looking good. The new environment with the less meetings, the mean level salaries as opposed to very low salaries has caused us to be able to get more attractive candidates, particularly for the senior roles. And so we're encouraged about the outlook for filling those positions. I'd be happy to take any questions on the budget.
Questions for Scott? Pat?
So we're about a third of the budget, NYCERS. Our contribution is about a third relative to
Correct.
the other funds?
Correct. That's the current billing rate.
And I'd like to know what the percentages are for the other funds, when you have time.
Sure. Yeah. I think, I think it's a matter of statute. We can get that for you.
Yeah, I think the teachers are probably close to us.
It's by assets, the teachers have more assets.
Yeah, the teachers have more assets, roughly, right now, if you take a snapshot at this moment, the teachers are in the neighborhood of 40% of assets, you're in the neighborhood of 30% of assets. But I think there's probably some lag impact in the billing rate, but I could get you the details.
Does that
Comes from the
count,
Bureau of Administration.
does that count the 403B, or is that just the pension fund period? The 40%?
Just,
I believe it's just the pension.
yeah,
Pardon?
I believe just the pension.
Yeah.
fund.
yeah, because the,
the 403B internally.
yeah. And there's no city contribution for the
403B.
403B
No,
or 401K, or the 457, it's all employee money, so I would think, is that right, Suzanne? Yeah.
As I understand it.
Yeah, well, the teachers have the 403B. I mean,
Right, but-
I know because I used to be a teacher. So.
Right, right. Ours is a 401K, they're very similar, there's some just technical difficulties, but we have a 401K and, right, John? Yeah, 401K and a 457, and it's all employee money.
That's
Yeah,
decent.
but that's in a separate, that's
So-
in the-
Correct, so that wouldn't come in the budget because.
Now, the question is that, a portion of the teachers, they call it the TDA, is invested with the, they call it block.
Oh, I see what you're saying.
You guys invest.
Yeah.
But I don't believe that that's counted. When we calculate, we use, current AUM, and then calculate a percentage from each system, and the 403B is not included.
Right. Okay.
We'll get back. You were asking whether the 403B assets are included in your asset total, because we manage those.
I don't think they are. I didn't think that. I was just curious.
Yeah, for the
about,
fixed teachers, so the teacher's fixed option, the assets are part of the pension fund, and we manage those. But I'm not sure if that's part of the.
I doubt it.
Yeah. But we'll get back to you.
Thanks.
Sure.
Mr. Bonilla, let's let the record reflect Mr. Bonilla from the Manhattan Borough President as well.
How often are the shares calculated?
I don't know, that would be Bureau of Administration, my guess would be annual.
So typically they use the prior fiscal year close. So fiscal year 14 for 15, this fiscal year closed 15 for 16. That's the rule of thumb that I think was what the original corpus approved.
question about your fringes. Does that provide, is it provided to you by R&B? It seems a little high.
The fringe is provided to me by the Bureau of Administration. I don't know what, that's a standard fringe amount that they use across the controller's office, I believe.
Mr. Schindler?
It's actually not in the budget. I talked to them about it. It's not included. We just talked about the salaries, but it's added on. I think as a, you know,
Scott, first I just wanted to say, you know, I think people have noted the increase of staffing and are really, I think right now pleased with the progress and really it's been great, and I think I really appreciate the opportunity to see this. It allows us to do our job as to oversee the expenditures of NYCERS. The only thing I would ask is perhaps as part of the March or even before, if we can get an organizational chart to kind of see where everyone is, where the vacancies are, where you've had these good hires.
Right.
It might give a better representation so we can see, and perhaps we know people who might want to apply for those positions, but or people out there would, and it would give us a better understanding of where they are.
There are currently 7 positions, and this is corpus and non-corpus, 7 open positions at the Bureau of Asset Management, and they're all, the postings are all on the website. So in terms of people that are interested in posting, by all means, we would love to talk to them. We will bring an org chart. Larry, it's a very fair question. We'll have one for you.
And just a follow-up is I guess it might answer itself, but as a result of our conversations later on asset allocation, there would be a shift perhaps without determining that result of where assets would be. Is it of your mind perhaps that there may be increases and decreases as a result of shifts of assets? Would there be a difference in expenditures as a result of that because certain asset classes have higher wages? Is there any thought given behind that?
Yeah, I mean, we're in the process of doing asset allocation for each of the 5 systems. And, you know, there are labor implications to the asset allocations. For instance, we show you a low cost with no alternatives and a cost with alternatives. And there are labor implications to that in terms of the costs of running the system. There are back office implications. I will point out that since the alternative asset classes have a very long life to them, you know, you can't just shut them off, and you can't shut the labor off either, because we have to be there to monitor the funds until they're closed.
And finally, just so because I know we're in public session, although there's a increase of expenditures here, it is our responsibility to manage this system prudently, and I would expect that with an increase of staffing, there would hopefully be somewhat of a reduction of our reliance on outside consultants, managers, and others, and perhaps see a fee reduction justifying the increases of staffing, right, including the benefit of better mismanagement and other positive effects of increasing our staff. Obviously, I know you've stressed, and the controller stressed, looking at fees and trying to find ways to reduce them. Part of that is a reliance upon a well-paid staff.
Yeah, there are a couple of issues that we're dealing with. One is that we're woefully understaffed relative to other public pension funds. That is something that the Funston report made absolutely clear. And so we first have to get to the level where we're adequately staffed. And that's an issue in the investment personnel that are billed to corpus. It's really an issue in our middle office personnel, which the Funston report goes into great detail. And there's a fair amount of restructuring and hiring that has to go on there. So at present, I'm not anticipating any labor efficiencies, save a decision by all 5 boards to change the number of asset classes that we participate in. And in terms of consultants, there is some duplication. There's purposeful duplication among the 5 boards, in that the 5 boards have 5 separate general consultants. They have overlapping services to us, but they don't have overlapping services to you, and that is your decision as to whether you want your own consultant or can share one with other boards. With the specialty consultants, we do have some asset classes where we have multiple consultants, and there may be some opportunity for efficiencies there.
Mr. Bernardes?
Do the 7 current vacancies account for any proposed increases in personnel that the Funston report suggests, or like some of the gaps that you just discussed, or are those before we kind of implement
Yeah,
some of
so
those proposed changes?
it's either 1 or 2. I can't remember what's been posted. It's a moving target, as you can imagine. We have started a new group called the Strategic Initiatives Group. Brought in a woman named Kara Schnapper, very senior executive, a lot of operations experience and technology experience, and she and her group are functioning almost like an in-house management consulting firm. They're helping us to re-engineer the Bureau of Asset Management, and she has a couple of openings there for IT related positions. You'll note in the Funston report that they recommend that we build IT capabilities within the Bureau of Asset Management. That'll happen in Kara's division, the Strategic Initiatives Division. You'll see postings for people in the back office, middle office. Those won't necessarily get charged to Corpus. Many of them may get charged directly to the city. But when you line up the staffing that Funston recommends in their report with the staffing we have today, most of the difference versus our planned staffing and what Funston is saying is sort of standard in the industry comes in the middle and back office. I think there are 2 more investment personnel on their wish list or sort of standard list versus what we have in our current plans.
But our current vacancies kind of account for those
Well,
projections?
2 of the 7 are for the Strategic Initiatives Group. It's either 1 or 2, if you're not sure. And then the rest are Senior Investment Officer for Hedge Funds, Senior Investment Officer for Infrastructure, Senior Investment Officer for Opportunistic Fixed Income. And then we have a couple of more junior positions. They're mostly investment positions. I have put all those posted assignments in this number, right? So that this run rate is assuming we hire everybody we've posted for, which I think is a good bet, and it gives you a full year's run rate. There are some proposed additions that my team has proposed as we look at the year ahead. I have not included those, but I will include them if we decide that we'd like to do them in March when we come to speak with it.
And I don't know if you said this earlier, I may have missed it, but the March presentation of discussion of the budget, will that include, because the Funston report talked a lot about the systems that need to be built out and things like that, and there'll be a cost to that we talked about. Will that be included, the potential costs of those build-outs?
I'm going to try to. If you all will bear with kind of rough numbers on the potential for new systems and that sort of thing, because we're at early stages of doing RFPs and that sort of thing. But if you're okay with kind of guesstimates, that would help give you comfort. We can give you that. My goal is to be as transparent with you as I can. There's a lot in motion. I'm going to talk about a lot of things when we meet in March that are operational, and we usually don't talk about with the boards. But as Funston showed, many of our issues are operational, and they involve the support systems that we have to run a complex asset allocation, and the need to beef those up. So I wanted to give you assurance that that's being taken care of, that we have plans to address it, and we have plans to address it in the remainder of the controller's term, which ends December 31st, 2017.
Yeah, I would just think, I think rough numbers are okay, knowing this is a long process, but if we're talking about a budget that we may have to help fund, I think having as much of that kind of discussion at the same time is helpful instead of having to come back later on.
You're absolutely right, and we're huffing and puffing to get there.
I know,
it's just that, the timing is tough because of just where we are in that cycle. But we see what you see in terms of the budget calendar, and we'll try to be as explicit as we can.
Thank you.
Yes, sir.
So given the consolidation of the different systems for investment purposes and the additional staff, have you dedicated any of the staff to monitor fees in itself, or is there any effort to do that?
Every single person in my employ who touches our external managers is focused on keeping fees to an absolute minimum. The back office folks, several of them are engaged in this process of bringing more detailed fee information into our accounting systems, and that's a very large project, and you know, we're very focused on it. So yes, absolutely, we all remain very focused on fees, and in the alternatives assets, at the structure of fees, which is really more of an issue than the fee levels themselves. But there have been discussions in this and other boards with the structure of the fees in the traditional asset classes as well, and so we're examining those very closely.
Any more questions about the budget presentation? Okay.
We can move to asset allocation. I'm going to turn the floor over to the folks from Callan. Jim and Bud are here from Callan. Sherry Chan is, oh, there she is right there. Sherry has an auxiliary exhibit to Callan, and I wanted to introduce two of my band colleagues. Mike Haddad, who joined us several weeks ago, is the group head of public and tradable securities, and you all know Miles Draycott, our chief risk officer. Mike and Miles and Alex Danier, the other group head, working very closely with me and Sherry and the consultants as we do the asset allocation. I wanted them to be here for the discussion. With that, I'm going to turn it over to Jim.
Before we get into Jim, I just want to tee it up. So we're happy to be able to provide you with results of our asset allocation study for you. A lot of work went into this study, but we realized that this is the first time this board has gone through the process of looking at asset allocation. So we understand that it is a very important decision for you all. We did look at a number of different scenarios that we'll walk you through, but chances are you're not going to come to a decision at today's meeting. So we encourage you to ask us to come up with other things you want to see to help you make your decision. We are here at your disposal. Jim would be happy to come back at any point in time. We could follow it up at the CIM with additional information to provide you with. Jim Van Hewitt is here from our home office. He's the Senior Vice President in the Capital Markets Research Group. He had given you the asset allocation education back in November. And I'm going to turn it over to Jim now to walk you through the results of the study. But again, ask a lot of questions and think about how you might want to see other scenarios if in fact what we have in this book is not adequate for your decision-making process. Jim?
Great, thanks, Bud. And thanks for having me here today. Scott and Bud have pointed out the purpose here is to decide on whether or not your current asset allocation is sufficient, or if you'd like to change it to something that's perhaps more efficient. The way that we approach this is a kind of a concrete manner, and that's that we looked at really 4 different scenarios. The first one assumed that you use just your existing asset classes. Was there any way to reallocate among your existing asset classes that would, for example, give you the same rate of return for less risk? The second scenario that we looked at was introducing long treasuries. Now, long treasuries have been discussed across a variety of our clients and in the industry in general in terms of the potential opportunity to provide some hedging to equities when equities are down. So we wanted to take a look at that. The third scenario that we looked at was using the existing asset classes but leaving out hedge funds. How important are hedge funds to the return and risk of the portfolio? And lastly, as Scott mentioned in his introductory remarks, we looked at low-cost options. And by low cost, what we mean is just using publicly traded securities, so avoiding the alternative investments like hedge funds, real estate, private equity, and so forth. Can we make this as simple as possible and still achieve the objectives of the investments?
Can I say just one thing on that? The estimate would be that the cost of the low cost option, and this wouldn't be totally index funds, it would be active traditional management, about the same dosage that we have today. About half of the combination of alternatives and core. The reason is you got about 10 times the fees and only 10% of the assets going into alternatives. And so roughly speaking, the high cost options are twice as expensive as the low cost options.
Can I just ask a question? Do you take the effect of the fees into account for the higher cost options on the returns?
So all the returns that are shown in this report are net fees. So fees have been taken into account. They've been deducted from the returns.
And correct me if I'm wrong, Jim, but in the public asset classes, you assume no active management, and in the private asset classes, you sort of assume median returns. You're not assuming above average results. So, the old saw that in private equity, for instance, you got to have managers who are in the top quartile. These guys are not assuming that you have managers in the top quartile. They're sort of assuming you have the average manager.
Yeah, very, very good. And then we're also assuming that the publicly traded investments are passively managed, deducting passive fees. So to the extent that you use active management and active management outpaces the fees that they charge, that's a benefit to the returns.
Hold on one second, I think. Okay, go ahead, Jim.
Just a question about what you said. When you referred to low cost, you said 10% of it.
No, the alternatives are roughly 10% of the
10% of the total cost.
Yeah. In his full mix, and I'm not sure exactly what yours add up to. It's generally
Higher.
a little higher. But it just as a rough ballpark, we can cost it out for you, but just as a rough ballpark, the low cost option is half as expensive as the high cost option at these mixes.
I know we're going to get into this later on. I don't need to jump ahead, but just in terms of requesting additional information, obviously hedge funds are a topic of interest for this board. I know that you had a number of slides making the case for hedge funds. Could you make a case against hedge funds for us as well in some slides? This way we can kind of see balanced information on both sides, because there wasn't any of that included in the presentation. Thank you.
Okay.
NYCERS is a very interesting subject because you do have a lot of different asset classes in the portfolio, a lot of diversification, more than many of the other clients that we deal with, which require that we come up with some special projections specifically for NYCERS, and those are listed at the bottom of page 1. You can see that there are some asset classes that are specifically implemented, that you run them differently than others might. They include opportunistic fixed income. Your hedge fund portfolio is not a generic hedge fund portfolio, and you also have some specific characteristics to infrastructure. In addition to that, we looked at long and short-term treasuries, bank loans, and value-added and opportunistic real estate. The last sub-bullet point on the page, I think, is one that we don't want to overlook, and that's that we've assumed that you're going to transition from your current Core Plus 5 benchmark to an aggregate benchmark. The Core Plus 5 benchmark, I think, has historically paid off for you, and the distinction between the two is that the Core Plus 5 reduces the allocation to shorter-term treasury securities. So as interest rates were falling, you actually benefited from having longer-term securities. You benefited from having exposure to credit risk in the portfolio. As interest rates rise, you'll still have credit risk in the portfolio, but you'll have some shorter-term securities that won't be as subject to the losses associated with rising interest rates. So that's why we advocate for a change in the benchmark from Core Plus 5 to the Barclays Capital aggregate. We talked about the analysis earlier, recognize that there are 4 scenarios, but in each of those 4 scenarios, we're looking at 5 different alternative portfolios. So we're not just saying that you have to look at only the 7% return objective for each of these scenarios. We look at more conservative as well as more aggressive asset allocations. Excuse me, and then finally, we looked at the performance or the expected performance of each of these portfolios in 3 different ways. We looked at the baseline, and then the other 3 alternatives we compared back to the baseline. The baseline is closest to what you have now. We're using the existing asset classes that you currently have employed. So how does adding long treasuries, removing hedge funds, removing all alternatives, how does that compare to the portfolios that are constructed with your existing asset classes? And we do that in the context of what are the annualized returns over the next 5 years, both on average and particularly if markets don't perform well, and also the cumulative returns under both of those circumstances, expected performance and underperformance, significant underperformance. So that's the context in which we looked at the asset allocation exercise. With that, I'm going to move to slide 3, which gets into our observations and conclusions. After we did all of the analysis, we felt that the best alternative used all of the existing asset classes that you use and has a 7% return target. That's the baseline asset mix 3, which we'll discuss on slide 9. So basically staying where you are in terms of exposure to asset classes, a modest change in how you allocate those asset classes to reach the objective of 7%, but not too many other changes. You can see here that generally the overall allocations to equity and fixed income stayed about the same. Opportunistic fixed income and hedge funds were also similarly sized. A little bit of additional assets into the real estate portfolio to add diversification. It was our conclusion in this preliminary study that long-term treasuries probably are not additive to the portfolio. As Scott pointed out, we're going to have a meeting of the minds with the other consultants and address any differences that we have. But currently, we think that that's probably not contributed to the performance of the portfolio.
And that is a big difference amongst the various consultants that serve the 5 boards, as the mayor's office knows. So we're going to have a technical meeting of the minds, sometime in the next few weeks. We'll invite anyone that's interested in going through those technicalities with us. But the Bureau of Asset Management is going to sit down, hopefully with all the consultants, and delve into this one decision, which is the power of long-term treasuries in the portfolio and the useful role. There is, as John Adler can attest, that where Callan comes out on this and where Rokotan comes out on this are polar extremes.
Try and sort that out. The third conclusion that we came to is that hedge funds can play a valuable role in the portfolio, that they provide good diversification for the portfolio. They provide exposure to return opportunities that are not available in other asset classes. We understand the disappointment in the historical performance of hedge funds, especially since you added them after the financial crisis. But we think that the prospects for hedge funds going forward would justify their inclusion in the portfolio. And then finally, not only do we think that hedge funds contribute to the performance of the portfolio, but that alternative investments as a whole contribute to the performance of the portfolio, primarily in the area of diversification and unique return sources to the fund. So actually, although alternative investments can seem risky at times, we think that they actually reduce the risk of the overall portfolio and make a significant contribution to the efficiency. The alternative asset mixes that we looked at in summary on slide 5, those just for mixes that include or that have target rates of returns that are similar to 7%, as I said, are shown on slide 5, just want to highlight some of the key differences. The current target mix is on the left-hand side, the first column on the left. So that's our starting point. The base mix 3, which we think is the most appropriate mix for the fund, is the next one over. Notice that that has, if you look at kind of the central box, or maybe the box about 2/3 of the way down the page, where you have a 10-year compound return and a standard deviation as a measure of the risk. You can see that the existing target mix has an expected return of about 6.82%. And the base 3 mix, we have reallocated the assets modestly to achieve your 7% target rate of return. That involves a modest increase in the risk from 13.55% to 13.79%. One of the reasons that we were not so interested in long-term treasuries is that if you move over to the third column now, for the same risk, for that same 13.79% standard deviation, we have a give up of 12 basis points or 0.12% in the targeted rate of return. No hedge funds, there's not a huge difference in the return and risk of the no hedge fund portfolios. In some ways, I don't think that that's too surprising. Hedge funds have returns and risks that exist between equities and fixed income. And so there are combinations of equities and bonds that sort of fill that gap. And so there are other reasons why we think that hedge funds can contribute to the performance of the portfolio, which we'll get into later on in the presentation. And then finally, low-cost mix 4, I think that the reason that we're not enthusiastic about that is pretty obvious on this page, in as much as the expected rate of return is 6.94%, so 6 basis points under the target of 7%. But notice the risk to the standard deviation here is over 15%, whereas the rest are in the high 13s. So that diversification that's introduced in the portfolio through the use of alternative investments really helps mitigate the risk of the portfolio. Now we're going to get, as I mentioned before, in each of these different scenarios, we have a range of asset mixes and some analysis of that range of asset mixes, which I'll get into next. But are there any questions at this point?
Yeah, Henry.
So let me get this straight. You're basically recommending, at least at the top of your recommendation, is this mix 3, which essentially keeps the status quo of what we've been doing before. So we've underperformed, not to your fault or the fault of BAM, right, or the board, because we go in with the best possible intentions. But we inherit this mess of asset allocation, and clearly we haven't, right? We haven't met the 7% target. And you're recommending we keep going that way?
When you compare it with the alternatives available, what other asset classes you can invest in, or conversely, what asset classes you might not want to invest in, we feel that this is the best option that's available to you.
To keep doing what we're doing.
Well, Henry, the current target asset mix was instituted in 2012, I believe.
That's right.
And over the years since then, we have slightly underperformed the 7% target. That's only been a 3-year horizon. Over long term, we do expect that we will meet the 7%. So it is relatively a short period of time to measure that target return success or failure.
Yeah, I 3 years, it's more than a long time for me. And so it seems to me that if, and I remember that back then, I remember going into some of the minutes that I was able to see. Some of the same presentation I'm hearing here, I read back in 12. It just seems to me that, what was it Einstein said, just doing the same thing over and over again is the quintessential definition of madness. And I think, you know, I'm, let's just say I'm a little disappointed that you're recommending to this board at the top of the asset, the very same allocation we've had slightly underperform over for the last 3 years. I think I was looking for a little more creative stuff, with all respect. But you guys are the expert. I just happen to disagree with, the top or the bottom of this stuff and more into the middle. But I guess that will be for the board to decide. It just seems to me that going the same way, just, tweaking here and there, it's not what I was expecting today.
Pat?
Yeah, well, what was it that, over the last 3 years, what was it that we achieved? What was the number that we got? If we slightly under, what was it?
I don't have it with me, but I can look it up. I'll have it for you in about 5 minutes.
Yeah, because they're very different years, 12 and 13, 14.
Yeah, it was, the overall, across the five boards in fiscal 2014 was some 17.5%, and the fiscal 2015 was some 3.5%. One thing you absolutely have to consider is the market environment that you're in. There was, we were not so much better in 2014 than we were in 2015. The markets were quite a bit different. The 3 years that we've had have been unusual years. The years in front of us are unusual years. It's going to be extraordinarily difficult in the next 3 years to earn a 7% rate of return. Extraordinarily difficult, no matter what your asset class is. And so, Henry, I would disagree with you on your time horizon. I think if you talk to Sherry, and we'll talk to her a little later when the actuary tries to figure out, what's the expected return, what time period should we compare the 7% to? She doesn't look at even the 5 and 10 year time horizons that we're looking at with Callan that we need to look at to set our asset allocation. She looks at a 30-year time frame, because these liabilities that we have to the 715,000 employees span decades and decades. And so we really have to have a long-term lens when we set expectations. So, Chair, I don't know if you want to comment on that now, but but it is, 3 years is not even long enough to begin to assess this kind of thing. We really need to look out 10-year results and so forth. And let's not forget that when we look in the rearview mirror over 10 years, we're going through one of the most extraordinary periods of financial history that we've seen. So it's here they're looking at expectations and versions of normal, and then they shock test it, which they'll get into in a minute, to look at really bad and really good scenarios. But the lens is definitely longer than 3 years.
Well, respectfully, you guys are the expert on this, but here's what do I feel. Like, so, looking at an initial rebound coming out of the recession of 8 or 9, and look at double-digit returns as compared to the years before, I think it's got to be taken into the context. It wasn't like we went from 7 to 14 and 17. We were doing extremely poor in 8, 9, and 10, and then all of a sudden we see a jump, obviously because the economy continues and rebounds. But the fact is, for the last 2 years, we've seen single-digit returns. And where I disagree with you, the effect we're seeing now in having to put our taxpayers' dollars to make up for the difference of what we have not been able to meet, I take that extremely serious. And while I don't have your expertise on this, it just seems to me that doing the same thing for the next 3 or potentially 4 years without looking and having an opportunity to view what we're doing and say, hey, folks, this isn't working. To me, it's more than a difference of opinion. It's a difference, perhaps, of philosophy that I, at this point, just have to look at what's in front of me and say, this is not working. And this is, with all due respect, you guys inherited this. This is our time to make our mark and then do with the best possible information we have here. And I don't think that doing that is just keeping the status quo.
I do have the information, and I was mistaken. The total fund has returned on a gross of fee basis over the last 3 years, 7.44% annualized.
That would be gross
Can you
public.
break it into years, Bud?
Net for alternatives.
It's the last three annualized, so the three total. I can look at each one, if you give me another few minutes. And then the 5-year trailing return as of 12/31 was 7.30 annualized. So the 3 and the 5-year number, we have met the 7%.
Although that's gross.
But that's
gross for public
markets and it's net for the private markets.
Yeah.
And I'd just like to note that, my understanding is that we're pretty close to the middle in terms of the performance of other public pension funds. So if you look at us versus our peers, we're also doing what, we would be expected to do. We're not an outlier in terms of performance.
Yeah, thanks, Suzanne, it's a correct observation.
And the other observation I would just make is that we did make relatively big moves in the last asset allocation change, and we are still implementing some of those changes as of today. So we actually haven't even gotten to the full effect of the current target.
I just wanted to make sure that I had the right mindset in terms of the asset allocation exercise itself. So what really is at issue in our decision making is the narratives or the stories or the conviction that you have in terms of how the market will do, right? So the performance that we've experienced, to what extent do we take that into consideration in that decision making in terms of the stories that you peeled off for us? And for example, when you make claims, assertions that hedge funds, for example, have negative betas, at least that's an attribute or characteristic in the portfolio, that's favorable. Does that mean that that was the case for us? And when you mentioned, for example, the characteristic in terms of it could perform, when in terms of, I know could and should and all that, but did it do that for us? And is that important to know in terms of our decision making in terms of future asset allocations? And the same with other assumptions that are made. I would like the assumptions to be spelled out a little bit more clearly, so that when there's buy-in, we know exactly what we're buying into in terms of conviction for future performance.
Yeah, absolutely. Our expectations, which are going to be we'll discuss on slide 6, are forward-looking. They're informed by history. We know what happened over the last 3 years. We know what happened over the last 30 years and 60 years and so on. So that comes into that kind of provides us with a range of reasonable potential outcomes in the future. But those are also informed by where the markets are today. What's the current level of interest rates? What's the price-earnings ratio on the S&P 500? Other statistics that tell you how markets are valued today are very important as to how we think they are going to perform in the future. So all of that is reflected in the values that we have here. Even with that information, there's a wide range of potential outcomes. And that's why we do the simulation analysis that I'll show you going forward, because we can make our best estimate as how things are going to perform, but clearly an important part of this is risk, and it gets to the comment that was made earlier in terms of taxpayer dollars that go into to fund these plans. We want to, in the expected case, earn the highest rate of return that we can to minimize the contributions to the plan. On one hand, we have to keep firmly in mind the fact that we can have these very poor market scenarios that could require even larger contributions. So we don't want to pursue returns in the expected case to the extent that we expose ourselves to very poor performance when markets are down that lead to higher.
We do have a section in the appendix, I don't know if we want to go through it, that details how we came up with the specific NYCERS hedge fund projections. And specific to your question about beta, so it's been a relatively short period of implementation for a hedge fund portfolio, but the beta for the NYCERS hedge fund portfolio has been below 0.2 and lower than it's been for the overall hedge fund index. So it has delivered in a very short period of time. We're talking about just a few years. It has delivered in terms of having low beta assets.
I'm thinking it, on this question and Henry's before it, we have a risk management chart that our investment committee looks at every week. It shows what the actual returns have been relative to what the asset allocation expectations were the last time we did an asset allocation exercise. And it sort of speaks exactly to the questions you're raising. And so, Miles, maybe when we go to the next sim, we can show that, because I think it's directly responsive to the question, how have the asset classes done relative to the expectations we had the last time we did the asset allocation exercise. And I think, you know, from your questions, it'd be useful. Yeah.
I think it would be helpful for trustees to have as part of this process, talking about the overall returns of the system as being perhaps in the middle. Then what were the returns of the top performing systems in our peer group, and what were their asset classes, to the extent that that kind of information is available?
Sure. Yeah, we have that, and we actually show that to you each time we talk about performance. If you go back and look at your performance charts, you can see where the median was, and you can see where the top quartile break was and the bottom quartile break. Remember, when you compare us to our peers, we're much more constrained than our peers in terms of how much alternative asset classes we can hold. We cannot hold as much private equity as many of our peers. We cannot hold as much hedge funds. We can't hold as much high yield debt as our peers. And in various periods of time, that greatly advantages our peers versus us. The past couple of years that we're talking about, it was not a disadvantage, because the core asset classes, most notably U.S. equities, not international equities, the U.S. equities outperformed everything. International equities have underperformed expectations quite considerably over the past 3 years.
For Callan, we have a peer group in our report that we can include. It's public funds of 10 billion or greater in assets, and it's about 40 public funds. So we can certainly include that as well.
And that's what we show you with the Tux University.
Yes, that's,
slide.
yeah.
Yeah, what I was going to say is, I think what Ray is asking for is not just what their overall performance was compared to ours, but their the attribution analysis, right? So that we can see why is it that they outperform us.
Yeah. That information we don't have. Callan may have access to that, but we don't have it in the Tux.
We have some information, because some of it's going to be our clients. Some of it's information we gather from third parties. So that would also, I believe you're also asking about asset allocation of those top performers. So we can drill down on that as well.
The asset allocation and the attribution analysis. In other words, where did this outperformance come from? Is it because they allocated more to high yield debt or what have you? Right?
And so, just for clarification, when you talk about your peers, are you talking about all the large systems, or are you referring to the fact that within the city of New York and the other systems, TRS and Board of Retirement System both have outperformed NYCERS, and they don't invest in hedge funds, for instance? Are you talking among the 5 funds, or are you talking about outside of New York?
Broader than that, it would be all large, over 10 billion in size public pension plan.
So, well, TRS is more than that, but so when you're talking about out of the state of New York, is that right?
Correct.
Both. So yeah, in total it's about 40. It's a peer group of about 40.
But for instance, New York Common might be in
Yes.
the comparison. They're in the state. But we look at, we're comparing outside of the New York City system. So we're comparing NYCERS returns to the other large pension funds. New York Common, NYCERS, CalPERS, CalSTRS, Texas Teachers, just a list of funds that would be well above 10 billion in size.
Larry?
This one issue of comparison to peers has always been a challenging one, because obviously we don't know the boards, we don't know what they were doing, and it really also goes to a question of their time horizon. You're talking about a asset allocation that was done 3 years ago. They may be more nimble. Some funds in the country actually will change their allocations in a way in which they'll do market timing, for lack of better words, and have outperformed as a result of that. It really is a challenge for systems like this and others to do that. We're not market timers, but it goes to the question I have is, we're talking about long-term liabilities and the long-term needs, but there is also this knowledge that the next couple of years are going to be especially challenging, especially in public equities and other areas of that. Yet, as Mr. Garrido said, we are looking very similar to the past, yet we know what's coming in the next shorter term. Is there any conversation about a shorter term? I know in the past it was ranges because that enabled BAM to have some ability. Is there any ability to allow for a little outperformance based upon the expertise and staff, or based upon staffing and others that are coming in, that would enable the system to do slightly better than a more stagnant asset allocation?
So what we're talking about now would be the target asset allocation.
Right.
And that's a very long lens exercise. We would be looking, 5 years minimum, more 5 to 10 years in this lens. And the chair would be looking 30, which he says the assumed rate of return. We do leave ourselves some room to change the allocation slightly, and we have bands for each asset class. So, for instance, right now we have tilted the portfolio versus the old allocation to do just what Callan is suggesting in the fixed income, to make it look more like the Barclays aggregate and less like a totally long-term bond allocation by buying short-term treasuries, which are missing from our Core Plus benchmark. When we put short-term treasuries together with the Core Plus, you end up with the Barclays Ag. They're actually recommending now we adopt the Barclays Ag. So we've made that tactical shift. It's the only one that we've made. We largely believe in rebalancing rather than tactical asset allocation, but we do have some flexibility to do it, as you suggest. And we will continue to ask for similar flexibility going forward, because for just the reason that we're tilting in fixed income today, there might be special circumstances that would cause us to want to tilt a little bit until our next asset allocation.
I have 2 quick questions. Scott, you had said that we compare the peer groups NYCERS to the other CalSTRS cover. Does that include? Are we breaking out 5 individual funds relative to each of those, or are we considering all of the city systems as one? When we
The
say
performance reports look system by system. So they compare NYCERS to the peers and teachers to the peers.
Gotcha.
Other than BERS, the results of the various New York City systems are quite similar to each other. The reason BERS is outperformed is that BERS takes more risk than the others. It has a 70% allocation to equities, which is outperformed in the recent
Gotcha. And my next question is, so in the beginning, we talked about how the asset mixes were evaluated against a 5-year basis, and then the chart on page 5 shows a 10-year kind of comparison. Where are the 5-year numbers? Are those relevant? That was how you measure the asset mixes. We don't see those numbers. We see a different projection here. So can you just speak to that?
Yeah, I mean, our performance expectations are intended to cover about a 7 to 10-year time horizon. The question that was raised to us is what would the impact on performance be over 5 years, especially the impact on contributions. Oh, sure. So yeah, normally we look at 7 to 10-year time horizon, and that's why we have the 10-year contribution.
But the analysis, so you're saying that the analysis was done on the 5-year because that is a concern about the city contribution, but for the investment purposes, we should be looking at the longer horizon, the 7 to 10-year.
Yeah, although they're going to be roughly similar. I think what you'll see over 10 years is you'll see a slightly narrower spread on the annualized returns, and the cumulative returns will widen out because you've got an extra 5 years. But it's important, I think, to recognize that the way that we evaluate portfolios is not necessarily on an absolute basis. We're clearly looking to make an absolute 7% rate of returns, but we're looking at how the performance of the portfolios is relative to one another. So if we move, let's say we add 5% additional equity to the fund, we expect that in the median outcome of the simulations that the return is going to be higher, but we also recognize that in a poor market scenario, the return is going to be lower. What's the trade-off between the higher return in the expected circumstance and the lower return in the poor market scenario? And how do we evaluate that? Is it worth becoming more aggressive to get that median return at the expense of potentially having a very low return to market? So, and hopefully that will show up in the exam.
Thank you.
Okay.
And just for the record, I did hand out the annualized returns as well as the calendar year returns. And you see that, as I mentioned before, we are ahead of the 7 over the last 3 and 5. Equity markets were good over this period. Actually, the diversification that we added to the portfolio in the way of hedge funds did not work out over the last 5 years, but that is different than what we project going forward. There could be down equity markets, and you look for other ways to diversify the portfolio.
Yeah, so for instance, in January, we haven't officially reported January yet, but the equity markets were down some 5% during January in the hedge fund portfolio. Nothing's finally, it looks like it was down less than 1% during the period of time. So you have, as these guys suggested, when you compare hedge funds, you have to compare them to a mix of stocks and bonds, not to just the stocks. And they model out to be about half and half. And you'll see in the mix with hedge funds, it has less international equity and less core fixed income. And when you model without hedge funds, you have to add it. So when you're comparing the performance of hedge funds, you have to look at it to a combination of stocks and bonds. You can see that just in the way they reacted to the down market in January. They also react the same way to the up markets. They don't go up as much, they don't go down as much. And the reason they're attractive from an analytical standpoint is that they go up and down at different times than the equity markets.
Hold on.
Dave yes, I had two observations and questions. The first thing is that I noticed that in this iteration, we're talking about the possibility of increasing our total commitment to real estate, increasing the subclasses of real estate, from 6% to 8% in the base 3, or from 6% to 9% in the no HF. So my observation is that, very simply, is that to get up from 6 to 8 prudently in 5 years would be challenging. Getting up from 6 to 9 prudently in 5 years, I don't see. So we're talking about a longer range perspective. Secondly, I wanted to ask about the international commitments. Getting the OHF3 allocation to work requires an increased commitment to international equity on the order of about 4%, as well as an increased commitment to emerging market. So my question, which I'll raise to you, but as a ponder for myself, is to what extent the risks in these commitments are fully reflected in the standard deviation.
That is a good question. I mean, I think that it is incumbent on us to do the best job that we can to reflect the risks associated with international, generally, and emerging markets in particular, in the standard deviation. So they reflect the slowdown in China. They reflect the conditions in continental Europe and the Eurozone. They reflect Eastern Europe, South America. It's a lot to include in one number, but that's what it is. And currency, yes, but it points out that we reflect currencies as well, since these are unhedged portfolios.
And in fact, Dave, when you look at the past years since the last asset allocation, and you look at which asset classes have done what relative to the expected band that Kellen had, you'll find that there's only one noticeable deviation, and that's to the international equity markets. And they've underperformed, over these past few years for all the reasons that we all know. So it's not surprising, since the long-term expectations haven't changed much, that when you do an asset allocation, it would be an attractive place to put incremental capital because you're averaging in at lower relative prices.
And I'll get a little bit ahead of myself. I think one of the observations that we had was that while we are in favor of increasing the allocation to international, recognize that the existing proportion of international equity in emerging markets is about 40%. And we're arguing in favor of having a 75% developed, 25% emerging markets.
Yeah, so there's an awful lot of information here about hedge funds, almost romanticizing the idea of funding. And this is what I cannot comprehend. Your start analysis goes back to 2009. We didn't start investing until 2012, and even then, at that point, we did it at a very small amount. In the discussion, we talked about how they have a lot of fees and how they have underperformed. Not since 2009, where the market was markedly better for hedge funds, but since the time that we began to invest in 2012. So, on the one hand, you say 2012 was too short to now. 3 years is too short analysis, which shows clearly an underperformance, high fees, and a lot of the other pieces that we've talked about that make me worried, like transparency and what they're doing in terms of the way they're investing. And it just seems to me that there's an awful lot of information here, as I think was said before, about why we should stick in it and not enough about why we should. Like the fact that the other two systems, whether we like it or not, have in fact don't have hedge funds. Both the teachers and bears don't have hedge funds. So I think you've heard me enough talk about hedge funds for a decade. But I just feel very strongly about what I've seen, and I think you guys provided an analysis at our request that was very thorough. And other than one hedge fund that did extremely well at 78%, that shall not be named, and then the other ones who did extremely poorly, and you average it out, goes down to the single digits. It seems to me that it is insane for us to keep investing into that as an asset allocation. And I don't see the reason why there's so much activity in these slides about why we should continue to do something that hasn't worked. So I don't fault you guys, and by the way, this number, Bud,
Yes.
is a calendar number. It's not an annualized number. It's not a year-to-date number. And it's wrong in every one of them, in terms of what I've been able to see of the report the controller puts out. But having said all that, I think that it just makes no sense for us to continue to go this route when all the other major systems that have in fact overperformed are not doing that as an asset. So I don't understand why we're going through this analysis again.
You should go to 22 to 24. That's the case for and against.
I was just going to say, there's an awful lot of additional material here in the presentation. It might be helpful to start, sort of put this topic aside for the time being. And go. I'm not suggesting that. We would just have the benefit of going through the additional information that's there, and then we can come back to this question, and the board could ask, for whatever analysis that they would like.
Yeah, and I think one of the things that would be quite helpful, excuse me, Dave, for a second. One of the things that would be quite helpful is for Jim to finish his presentation, for Sherry to give hers, because what Sherry's going to do is to take the risk numbers and translate them into something real that is a meaningful variable. And I think that kind of sets up the whole choice that you all have.
And in page 22 to 24, we will get there, but that does cover the case against hedge funds as well.
Right.
Yeah. So we're trying to get, highlight some of the reasons you want to invest or continue to, and also reasons to not invest.
Right, I think people look at those pages, but they fail to recognize that page 23 is a case against hedge funds.
And, right, as is part of the, yes.
Right.
Just a quick question. In regard to the other funds, other than hedge funds, are there differences in the allocations to all different asset classes, or is it just simply the one asset?
There are some small differences among the systems. The one large one that you mentioned is that BERS and teachers do not invest in hedge funds. BERS was much later in some of the alternative asset classes. And they have a higher allocation to equities than the other funds. For instance, I think the teachers has a 63% allocation to equities and BERS is 70%. Also in terms of the real estate holdings, teachers and BERS and FIRE as well have REITs, which are public real estate holdings. So there are a number of differences.
Okay, thank you.
But the main one driving the long-term outperformance of BERS, and BERS, you know, as you saw from the last sim, noticeably different returns from the other systems, is that BERS does take more risk with the 70% equity allocation. And we've served up for you a similar higher risk alternative in the low cost alternative that takes similar amounts of risk.
Dan?
The allocation to large cap and small/mid cap, is that a tactical allocation or is that the market for the two
Those are our recommended weights to the large and small mid.
Okay, so it represents an overweight to small and mid caps, is that right?
It's about a market weight to small mid cap. Yeah, I mean, the definition of market weights depend on the index that you use, and we sort of split the difference.
Yeah, the reason I asked is now in academic research, there's some papers that demonstrate that there is no historical small cap premium, risk premium. I don't know if you're familiar. You've seen some of those papers.
Yeah.
So but in your expected return, you do still show a small cap premium. So I just wanted to see how that builds into your asset.
Yeah, and I think the small cap premium takes into account the risk in the academic papers that you're referring to. So you're compensated for the risk that you take, but not more so. In addition to that, what we've seen is that small cap active managers tend to outperform the index if you select them carefully. And so consequently, we want as much exposure to that additional alpha as we think is prudent.
So you're saying it is a overweight then, or
no? It's still a market weight.
It's still a market. So it's a market exposure.
Yes, but we advocate for more active management in small cap than in large.
Got it. Thank you.
Okay, with that, why don't we let Jim finish his presentation.
Actually, I mean, this is actually a good context for the very next slide, slide 6, where we show the expected returns and standard deviations. And I'd like you to focus on the third column from the left, the 10-year geometric, the 10-year compounded rate of return. And this may really inform some of the arguments that we'll make later on. And that's that if you look at the top portion of this portfolio, we have expected returns for large cap, small, mid, international, emerging markets. Recognize that we're looking at low to mid 7% expected rates of return, and your target rate of return is 7%. So if you want to hit a 7% target rate of return, and your equity portion of your portfolio is only returning about 7.5%, you need to have a fair amount of equity, right? You could increase the return of the portfolio by having even more equity in the portfolio. But if you look at the far right-hand column, you'll see that the standard deviations range from 18 to almost 23%. Our opinion at this point in the market cycle is that you're just being fairly compensated for the risk that you're taking in equity. And to take more risk in equity to have a higher allocation to equity, you may not be compensated appropriately for the risk that you're taking on. That's really our concern. And also by virtue of the fact that the standard deviation in equity is high, we want to diversify that as much as we can. And that diversification comes from not only public fixed income, but opportunistic fixed income, the real estate allocation that was alluded to earlier, and if I dare say it, hedge funds as well. So we're looking for the most diversification that we can, recognizing that you have to have a relatively high allocation to equity in order to meet your 7% target rate of return in this market environment. On the next page, we have the correlations movements between the asset classes. The only point that I would make here is that the correlation can range from -1 to 1, with -1 being complete diversification. When one asset class goes up, the other asset class that you're looking at goes down all the time. The key here, and this would be an argument for or about the importance of long-term treasuries, and so I don't want to get into it too far, but just as a kind of a prelude to a future discussion, recognize that if you look at the first 4 columns, those are the correlations of with the 4 major equity asset classes: large cap, small mid, international equity, and emerging markets. If you look at the second yellow highlighted line, that's the correlation for long treasuries. So -0.15, -0.17, you can read across there. It's less than, or actually greater than -0.2 for all of those. If you look up 2 lines, line 6 for fixed income, notice that the correlations of core fixed income with respect to equity in our expectations are not substantially different than the correlations for long-term treasuries. So consequently, our argument is that the additional diversification effect of long-term treasuries is not substantially different than for fixed income, yet the risk that's shown on the prior page is substantially higher. It's over 14% for long treasuries and under 4% for core fixed income. That's just kind of a prelude to the argument that we have that long treasuries, while they can be beneficial in limited doses to the portfolio, in large doses are probably not as productive as we'd like them to be. Now, the point was brought up earlier in terms of international. How are we capturing everything that we should be capturing when we look at international allocations just in the standard deviation and correlation? And the answer to that, as I gave, is we attempt to. It can be challenging, but we don't only look at, when we come up with these portfolios, risks and correlations. We look at how markets behave in different scenarios. And so consequently, on slide 8, we give you an example of that. And this is a very simplified schematic that recognizes that different asset classes perform differently in different scenarios. The 2 key scenarios addressed here are economic growth and inflation, so high GDP growth or GDP growth and the rate of change in prices. And notice that we look at things like in the lower left-hand corner, low growth, low inflation, and the government bonds we would expect to do well. What we don't say here is that we would also expect that equities would do particularly well in this environment. Consequently, that's where the argument comes for diversifying or trying to hedge equities with long treasuries. But the point here is that while we try to capture as much as we can in the statistics, we recognize that there are things that are not amenable to being captured in the statistics. We still we put a qualitative overlay on all of our analysis to make sure that we are doing a full representation of the benefits and the risks of each of these assets. those are sort of the preliminary remarks. Now we get into the nitty-gritty of each of the different scenarios that we wanted to look at. The first of which being the baseline asset allocation. And this table here, although it looks similar to the table that we showed several pages ago, differs in as much as we're only looking at the baseline asset mixes, so the asset mixes that we currently have in the portfolio. The way that they differ is in the returns and risks of the portfolio, which are a function of the asset allocation. So base one of the third column from the left is constructed such that it has a 6.5% targeted rate of return. And when we put the risk returns and correlations of each of the asset classes in the model, what we ask the model to do is, for a target 6.5% rate of return, give us the lowest standard deviation. Construct a portfolio, weight the asset classes such that the standard deviation of the risk is minimized. And the model came back and said that the lowest standard deviation you can get for that 6.5% target is an 11.37 standard deviation. And the way that you do that is to allocate to the asset classes in the way that's shown in the top part of the table there. So 19.9% large cap, 5% small mid cap, and so on down the column. The other constraint that we imposed, or the other constraint that we recognized, was the basket clause, and that's addressed at the bottom part of the table. So you can see each of the lines represent each portion of the basket clause. For base one, you can see that 6.5% of the basket clause is taken up by non-U.S. equities in excess of 10%. 5.6% from private equity, 5.7% from hedge funds, and so on down the table, such that we come up to, as close as we can, a 23% allocation of the basket clause. Now, legally, you can go up to 25. Historically, you've always had that cushion in there just to make sure that you don't violate the basket clause. As we move from left to right across the page, base one, as I pointed out, has a 6.5% targeted return. We increase the targeted return for each of the subsequent allocations, so 6.75 for base two, base three, 7%, so your actuarial targeted rate of return, and so on up to 7.5%. The reason being is that, as I mentioned before, we think that the risks associated with equities are now high with respect to the returns that they offer. But we wanted to see what the implications were in terms of a total portfolio in the total portfolio context. So, how much risk do you have to take to move from 7% to 7.25% for the entire portfolio? You can see that it's about 1.5%. Conversely, if equities are have high allocations relative to the returns that we expect, there might be a time period where you'd want to back off from trying to achieve your targeted rate of return. So we wanted to show more conservative asset mixes. And by the way, I think as a point of context, we have a number of our clients who are saying, you know, for the next 5 years, we think that markets are risky enough that we are willing to target a return that is less than our actuarial rate, waiting for these markets to work out some of the difficulties, the high price earnings ratios, the high price to book ratios, low dividend yields, low interest rates, because our expectation for core fixed income is about 3%, which is very low, with the expectation that in 3 or 4 or 5 years' time, when interest rates are recovered, when valuations are more reasonable, we are going to earn in excess of our actuarial discount rate. So it's not out of the realm of possibility or reasonableness to say a 6.75 targeted rate of return could work for us over the next few years. But we have focused on 7% targeted rate.
The 6.82 current target, was that, did the board decide to have a target below the actuarial rate at that point?
No, that was not an explicit decision. That's a function of, we've updated our expectations since the board made the early draft allocation decision. And in doing that, we've reduced the returns that we project for equities.
So 7% at the time, this is just using the new expectations with the old asset mix, and it's not at 7, so that's why we have to rejigger into at least base 3.
Do we have a feel of how that would look for a 30-year return? Would it be higher?
Yes, it would definitely be higher.
That's another variable too.
Yeah, absolutely. So if we were to look
For
at
10 years, it's 6.82, but for 30 years, that would be higher than the
Well,
actual.
exactly. So for example, I think the easy example is that, our expectation for the next 5 to 10 years for bonds, as I mentioned, is 3%. Well, that's because we're starting with a 10-year treasury of like 1.7, and the aggregate is a little over 2% in yield. We expect that to rise over time. So at the end of the 10-year time horizon, they'll be significantly higher. So if you start your 10-year time horizon 5 years from now, maybe fixed income is earning 5%. On 20% of your portfolio, that's 1% extra return rate.
What's the current riskless rate of return?
The T-bill is yielding next to nothing. Yeah.
So if I were to be calculating the Sharpe ratios for that one, I would just put a 0.
Pretty close.
Yeah. That's an excellent point. I've covered most of the points on slide 10 already, except to say that recognize that even though we are looking at targeted rates of return that span only a 1% range, the allocations to the different asset classes vary substantially. In mix 1, you've only got about 41% public equity, but in mix 5, you've got 64. In mix 1, you've got about 34% fixed income. Mix 5, publicly traded fixed income. Mix 5, you've got less than 10. So in order to make that move from 6.5 to 7.5, you really have to change the allocations to the individual asset classes. Yeah, also it's worth looking at some of the non-core fixed income asset classes. So TIPS is about a third of the way down the page. You can see in mix 3 it's about 2%. Let's look at emerging markets debt. It's less than 1%. The implication there might be with these small allocations that these are not useful components to your bond portfolio, and we don't believe that. We think that these can be important components to the bond portfolio, but recognize asset allocation at this level is kind of a blunt instrument. It doesn't do a good job of saying exactly how much you should have in emerging markets debt, exactly how much you should have in TIPS. Or high yield, for example, high yield and bank loans don't have any allocations. It's not that we don't think that they're useful, it's that we think that those allocations are probably best determined when you're focused specifically on your fixed income strategic plan. So once we've allocated, let's say, 25% to fixed income, now how should that be structured? That's when it's best to address emerging markets debt, bank loans, high yield, and so on. We want to make sure that you don't get the impression that those are not valuable portions of the asset allocation. Because they have low allocations, we think they are. This is just not the best place to look at.
We were thinking at this juncture more to point the discussion at low-cost alternative or high cost with hedge funds, high cost without hedge funds.
Yeah.
And so there's a lot of detail in here, and what Jim's saying is that detail's going to change once we pick one of those paths as we start to look at it differently. But this is what the optimizer shows you, which is a good proxy for what the overall results are going to look like.
Yeah, we want bonds and stocks and alternatives are the key allocations to the market. Which is much of what's discussed on slide 11. I also, the second bullet point down on the top, I mentioned this earlier, Your existing target has about 40% of non-index equity targeted towards emerging markets equity, and we would argue that something more towards 25% is a more efficient allocation to emerging markets equity, and that's more along the market's weights. As the 40% allocation is an overweight relative to the market capitalizations today. That's not right, 25% is just a very modest overweight now, given the poor performance of emerging markets. And then I made the point at the bottom is that don't take away that we think that non-traditional fixed income doesn't play a role. We certainly think that it does. Now we get to the simulation portion of the analysis on slide 12. And what we've done here is we've taken the expected returns, the standard deviations, and the correlations. And essentially what we've done is like scenario analysis. We go through and for each of the asset mixes we say, well, what happens if the equity market performs well? What happens if the equity market performs poorly? What does the bond market do in each of those scenarios? Unfortunately, if you do this in scenario analysis, you have two issues. Number one, what scenarios do you construct? It's hard to cover all the scenarios in a subjective basis. Number two, it doesn't tell you what the probabilities are associated with each of those scenarios. So what we do is we address this in a statistical approach. It's called simulation analysis. You can think of it as scenario analysis. But what we're doing is we're doing 5,000 simulations. So rather than trying to take 4 or 5 different scenarios, we're trying to cover the waterfront by doing 5,000 simulations that are consistent with the returns, risks, and correlations that we have for each of these asset classes, so that we get a broader range of potential outcomes and we can attach probabilities to those outcomes. And the results of that exercise is shown on slide 12. The table at the bottom corresponds with the bars at the top. The very top of these floating bars is it's the 5th percentile, and that reminds me that I should say that there are different conventions. Some people call the 95th percentile the tops of the bars. It turns out we call it the 5th percentile. And conversely, at the bottom, some people call that the 5th percentile. We call it the 95th percentile. But if you look at our convention, 5th percentile, top of the bar, median in the middle of the bar, and 95th percentile. The median is our best estimate of how we think these portfolios will perform over the next 5 years. And as you can see, as we move from more conservative in base 1 to more aggressive, as we talked about in the prior table, we moved from about 6.5% expected return to about 7.5% expected return. So no real new information here relative to the table. The real new important information as we see it is in the 95th percentile. So there's a 5% probability that these portfolios could perform at this level or below. So the red numbers, and they're red because they're negative, show the returns at a 5% probability that you might experience. So think of that as a 1 in 20 year potential outcome. Once every 20 years, we would expect that base mix 3 would have a minus 3.3% loss annualized over 5 years. So that's a fair amount of risk if you think about it, that you have an average return of minus 3.3% each year, well, on average for 5 years. So that's why, we talked about that before, pursuing more return, having more equity in the portfolio as one of the funds does. Well, this shows you the downside. If we increase the equity allocation from base 3 to base 4, it's about a 6% increase in equity. We increase the return about 0.2 to 0.25% in the expected case, but notice that the 95th percentile falls by about 0.8% per year for 5 years, measurable amount of risk. The other way that we looked at it is on slide 13, and these are cumulative returns. And so base 3 over the next 5 years, our best expectation is that on a cumulative basis, net of fees, but before active management in the public asset classes, you would get a total cumulative return of 40%. In the 95th percentile, you can have a cumulative loss of 15.5%. I think what's interesting about this example is that if you compare it with the target rate of return, notice that in the 95th percentile, they're about the same. Potential cumulative loss about 15.5. Base 3 does better by about 1.2%. Or to put it another way, if you were to achieve the same expected rate of return, or virtually the same expected rate of return, you could do that with base mix 2. So we got 38.8 versus 38.6, about the same. But by becoming more conservative, by about taking about 6% of the equity off the table, you could reduce your 95th percentile loss from 13.5 to 12.6. So you can either keep your risk the same and increase your return by moving to base mix 3, or if you wanted to take some risk off the table, you get about the rate of return that we think you'll get for your existing target, but reduce the risk by almost 3%. Something to think about. That's the analysis for the baseline cases. If not, I'll just very briefly talk about the long treasuries. What we did here on slide 15 is we took the 14 is we took the allocation to core bonds and we divvied it up pretty much equally between core bonds and long-term treasuries to look at what the implications would be. If you look at the middle portion of the table or the lower middle portion of the table, what we did was we tried to keep the standard deviations or the risks the same as in the baseline mixes and evaluate the impact in terms of returns. And if you compare baseline mix 3 with 50% long-term treasuries mix 3, you can see there's about a 12 basis point drop in the portfolio in terms of the expected rate of return. Now, as Scott pointed out, there's some differences in opinion as to what the long-term treasury returns would be. It's a very challenging asset class at this point to forecast, both because you don't know where the ending yield is going to be and you don't know the time frame it's going to take to reach that ending yield. I think what's really important with the long-term treasury analysis is that if you look at slide 16, if you compare mix 3, the 95th percentile, what you'll see is that we expect worse returns on a 5-year annualized basis on the order of 0.3 to 0.5% than with just core bonds. What's going on there is that because we have, relative to other consultants, a higher correlation, long-term treasuries don't always hedge equities. I'm not saying that they never hedge equities. They just don't hedge equities as frequently as some others believe. And because of the volatility of long-term treasuries, which again is about 14%, they can actually lead to larger losses in some portfolios. So that's our concern. As I say, I won't almost dwell on that because, as Scott pointed out, we're going to try and come to a meeting of the minds, and we'll probably discuss this further. On slide 17, that shows the 5-year cumulative. There are similar results here, so there's not a large difference in the conclusions that you would reach from either slide 16 or slide 17. I think we'll probably spend more time, I suspect, on the asset mixes without hedge funds, which begin on slide 8. So here we took basically the same optimal mixes as we had in the baseline. We removed hedge funds, asked the model to distribute the assets across the other asset classes. And as Scott pointed out, if you compare the mixed 3s what it shows, first of all, is that looking down at the basket clause, I think is the clearest way to see it, that now non-US equity in excess of 10%, we now have 10.7% in the basket clause associated with non-US equity. So the room made by removing the, approximately 4% in hedge funds is taken up in part by additional non-US equity. And what that does is that gets the non-US equity versus US equity allocation more like what we would have if we didn't have the basket clause. Right now, because of the basket clause, you're underweighted relative to the way we like to see you allocated to non-US equity. Remove hedge funds, you get a little bit more in non-US equity, so you're closer to where we'd like to see you in non-US equity. Some additional part of the allocation is taken up in fixed income, mostly in core fixed income, but in some of the peripheral fixed income asset classes. So that, as I said before, the approximately 4% allocation to fixed income, or excuse me, to hedge funds is distributed across equity and fixed income. Not surprising, hedge funds tend to have returns that are in between equity and fixed income and risks in between equity and fixed income. If you look at, I've covered most of the points on slide 19. If you look at slide 20 and 21, so that simulation analysis, the range of returns, what you'll find is they look very, very similar with or without hedge funds. Consequently, the arguments for and against hedge funds are mostly outside of this area of simulation analysis and more into the pros and cons, the benefits and the difficulties associated with hedge funds. We have the pros on slide 22. We think they're a unique source of returns. They have the opportunity to make investments in areas that other managers don't have. By the way, the point earlier was brought up in terms of the opportunity or the ability to make opportunistic investment decisions. That can be very challenging for a large fund, especially in the public arena, because most of these opportunistic investments have to be made relatively quickly. And the decision-making process sometimes mitigates against that. Hedge funds have the opportunity to move in and be the portion of the fund that makes those types of tactical investments.
Opportunistic fixed would be another one.
Opportunistic fixed, yeah.
Capital could be drawn down by managers to take advantage of tactical opportunities.
Yeah, so we would consider those in the same bucket as opportunistic tactical investments. Generally, hedge funds have a low beta with equity. They tend not to move with equity. And their equity allocation, again, another tactical aspect of hedge funds, is their exposure to equities can change through time. They tend to diversify other asset classes as well. They tend to have relatively low correlations. And historically, looking before the financial crisis, they tended to do well when equities did poorly. Now, during the last financial crisis, they didn't have those characteristics. The question becomes why? One of the reasons is that hedge funds work through prime brokerages. And a prime brokerage market was definitely challenged in the illiquid environment that we found ourselves in 2007 to 2009. Another reason is that the government, in the course of the financial crisis, banned short selling, which is a key part of how hedge funds operate and how they make money. A third part, and we hope that this is a lesson learned on the part of hedge funds, is that they offered liquidity provisions that were probably overly generous for the type of market that we had during the financial crisis. So in other words, if you wanted to get your money out, you could do so in 30 or 90 days. During the financial crisis, what happened is that investments that were beaten down, that would ultimately recover because people wanted to get out of hedge funds, the hedge funds had to liquidate those investments at basically fire sale prices, which hurt their returns. Had they had more stringent liquidity provisions, had they forced people to stay in longer, what would have happened is those investments would have recovered and those losses would not have been realized.
Can I ask a question on that? Was that that ban temporary? The short seller?
Yes, the ban is no longer in place. Now, the case, and actually, I see where maybe some of this was misleading. We were making the case for hedge funds, but we also, on slide 23, showed some of the headwinds for hedge funds. So on slide 23, the headwinds are a lot of assets have moved into the hedge fund area. You know, where in 2005 we had just over $1 trillion. Now we're working our way up to $3 trillion in hedge funds. That's clearly going to squeeze the opportunities. There are more funds, more assets chasing the strategies that your hedge funds would chase. The advantage that you have in this area is that you're a fund of substance. You have assets that these managers want to have. You're a long-term investor. I think you'd be attracted to some of the better hedge funds. You could have above average, you could employ, we would expect you to employ above average hedge fund managers. The second bullet point here is that recognize that hedge funds often quote their returns as a cash plus an excess return. When cash is trading at 0, hedge funds are providing excess returns. When cash is trading at 3, you can stack your hedge fund manager value added on top of that 3% base. The third point here is regulation FD. It used to be the case that hedge fund managers could go in and talk to publicly traded companies and get what amounted to inside information. Some forecasts of, let's say, profitability that were not fully released to the public. Since Reg FD, that's no longer the case. So hedge funds have to dig deeper to get less information than was the case before that. Also, we don't know what the corporate activity market is going to be like going forward. We don't know if there's going to be more or less M&A. We don't know if there's going to be more or fewer public offerings, initial public offerings. We don't know what the corporate transactions are going to look like. So we don't know what the opportunity set for hedge funds is going forward. And if that opportunity set is narrow, then hedge funds are not going to perform as well. And I guess just because we're so used to having made these arguments, some of the other arguments that came up against hedge funds we think are perfectly valid and worth bringing up. The fees are high. Right? They can come down marginally, but you're still paying more money to invest in hedge funds than you are in publicly traded asset classes. They invest in exotic securities that are hard to understand. They have exotic trading strategies that are hard to get your hands around. They lack transparency, which is kind of the other side of the coin of the exotic trading strategies, as well as the lack of desire on the part of hedge funds not to reveal their strategies so that they can execute them. So we want to make sure that we acknowledge those downsides as well. It's not like we're trying to sweep them under the rug. We acknowledge that those can be problematic for many funds, including yours.
I'm sorry, so then, since I made the comment previously, so the headline is a little misleading. The case for should be for / or against.
Yeah. Yes.
So that this high fees took it, you were actually using that as an argument for hedge funds.
Yeah, no, we certainly would not argue that the high fees are a benefit of hedge funds.
Because it says are important maintaining this edge.
Okay, then that's down on the next slide, on slide 24. Is that they charge high fees, but they use that to compensate the underlying managers, and to the extent that you can offer better compensation from a hedge fund than you can for, let's say, a publicly traded equity manager, you're going to get the best and the brightest that you would expect would add over time.
So, I'm sorry, you would expect would
add returns over time.
And does your analysis show that? Have you done a compensation analysis?
Oh, we have not done any analysis that shows, for example, that hedge fund managers that offer higher compensation outperform hedge fund managers that offer lower compensation. We haven't done
Or
that.
that outperform publicly, what did you?
Oh, I see. So the compensating managers, yeah, I mean, I would say that the argument there is in the performance of hedge funds themselves. You know, so it's not not a direct analysis trying to correlate the alpha added by hedge funds associated with compensation. It has to be on an absolute basis. Do hedge funds add alpha? Do hedge fund managers have active management value added?
That might be interesting for, I have a feeling we're going to come up with a to-do list by the end of this meeting. But that would be an interesting analysis to see about the additional alpha.
Mr. Chair?
Yeah, sorry. Yeah, go ahead.
But couldn't you also put the high fee slash compensation on the negative column as well? Because with the increase of compensation also comes perhaps a misalignment of interest, an increase of risk taking by hedge fund managers in order to validate both themselves personally, but also their compensation in order to increase their compensation. Those that make the most also make the most. So you know, a lot of us would look at that as possibly cuts both ways.
Yeah, you know, and I think that's a very interesting point. And I'd like to address that in two ways. And have my colleagues chime in too, to the extent they want to add something. First of all, we would argue that there's an alignment of interest because hedge fund managers, as part of their compensation, they invest their own personal assets in the hedge fund. So theoretically, that would argue that they wouldn't want to take more risk than they feel comfortable taking with their own assets. Having said that, one of the issues associated with hedge funds, I think, is the competition that I think that they have with equity funds. So when equity was doing well before the financial crisis, hedge funds underperformed equity, as we would expect, but I think that hedge fund clients expected hedge funds to do a better job of keeping up with equity. I think in order to, for whatever reason, some of which you've articulated, hedge funds took more equity-like risk in order to attempt to keep up with equity, and they were punished in the financial crisis for taking that extra equity exposure. So to the extent that we identify hedge funds that stick with their strategies, regardless of what the equity market is doing, we're going to have less of that competitive pressure that led to poor returns during the financial crisis. So less of that incentive to introduce equity-like risks into hedge funds in order to, either to keep up with equities, either to maintain clients, to maintain their compensation, or whatever the motivation might be.
And as you all know from the many times that Neil Messing has been here and Jim Fawcett at Axia, as well as Kellen McFadden, our hedge fund portfolio has very low exposure to the equity markets. It's got a beta or exposure of 0.2, which is below average for the hedge fund funds. They've made that adjustment in modeling hedge funds here. But for just the reasons that Jim said, we've tried to keep a portfolio of hedge funds that are not trying to keep up with the equity markets. They're trying to produce a different return stream that looks like more of a mix between equities and fixed income.
So that's key. If you choose to keep hedge funds in the portfolio, it's important that you keep in mind that these investments are not designed to keep up with the equity market when you have years like 2012 to 2013. That's not their job.
By the same token, we'd be disappointed if they didn't outperform on the way down.
Absolutely.
And in fact, we're seeing some confirmation that they are outperforming the equity markets on that way down, as we would expect. There's nothing outstanding there. That's the way they're designed.
Yeah.
Earlier, you said the hedge funds that we have are not generic, and there are many different kinds of hedge funds. There's the event-driven, there's the long-short, there are others that we have invested in. So we're not just in the long-short.
You don't have what would be considered a market weight exposure to hedge funds. As Scott pointed out, a specific design to your hedge fund portfolio to keep the equity exposure of your hedge fund portfolio low and to maximize the opportunity for active managers value added. That's the emphasis of the portfolio.
You want to get almost all of the extra return in the portfolio, extra return above the cash, from added value, from insights to the managers, not from having exposure to the equity markets. We can get exposure to the equity markets almost for free. There's no reason to pay somebody $2 and $20 to get exposure to the equity markets. So we try to structure the portfolio so that it's giving you cash plus the return from pure active management. So you're paying a lot, and so everything that you're getting is based on the value added that's being produced by the manager.
If I could, I just wanted to make a general observation about hedge funds and our opinion of those. The last time we did the asset allocation study, we went through a similar exercise and talked about the pros and cons of investing in hedge funds. And at that time, there was an appetite by the board and BAM to invest, and ultimately they made the decision to go into hedge funds. Today, what we're saying is just like emerging markets have severely underperformed over the last 5 years, hedge funds may have not produced exactly what you wanted, but we still feel there's a role for them. And we are talking about the pros and cons here, but we are not pounding the table for hedge funds. You could decide that you could get out of those, but we're just suggesting that past performance is not necessarily indicative of what's ahead, and that there is a role for hedge funds for diversification and a value-added proposition.
I will say, I mean, one thing that I find troubling is that in your, assessment of the main options for asset allocation, as you said, Jim, essentially the hedge fund portfolio, the portfolio with hedge funds, your base portfolio with hedge funds, is expected to generate 2 basis points in excess return over the allocation without hedge funds and for 1 basis point of risk. And it just seems, almost incidental. I mean, for all of the noise about hedge funds, we're basically getting the same risk return that we get without hedge funds, according to your analysis.
But what matters here is 2 things. First of all, we only have about a 4% allocation to hedge funds. And 4% of the portfolio, especially of an asset class that has returns between stocks and bonds, is not going to swing the expected rate of return of the portfolio very widely. The second thing is the timing of the returns. While on average there's only 2 basis points difference, if hedge funds can outperform, in the financial crisis, even though they disappointed in the financial crisis, they outperformed equities by like 20%. So if you get and that's the average hedge fund manager. So if you get net 20% ahead, 20% in excess of the equity return at the right time, when returns are down, that can be beneficial to the portfolio.
Another way to look at it, John, and I think Dave Kaczynski referred to it earlier. I would look at it as I'm sorry, Dave Katzman. I'm sorry. Mix my Daves up. Dave Katzman mentioned it earlier. Essentially, in order to get the same risk reward for the overall portfolio without hedge funds, we're forced to put more chips on international equities and on core fixed income. And that's not riskless. you know, we have international equities have underperformed, and they've underperformed expectations over the past 3 years. It's one of the reasons that they have attractive expected returns. Core fixed income, you're looking at some of the lowest interest rates in modern history that we're investing into, and so in a rising interest rate environment, you're taking those risks. Those are different risks than you're taking with hedge funds. You have an execution risk that the hedge fund managers can take their matched books and add value by finding misvaluations in the marketplace. And it's those risks are not necessarily correlated with the risks in international equities and fixed income. While statistically it comes out the same, with hedge funds you're taking you're getting more diversification in terms of the types of risks that you're taking in the portfolio. It's qualitative, doesn't show in the quantitative, but you can see just by the structures of the portfolio, you're taking different types of risks. They're execution risks that the managers can really find value. Because in a pure long-short portfolio, which is a good example, your expected value, if the manager has no insights, is not able to capture any expected return, you're left with cash returns, which, as we've said, are zero. So you're going to end up with zero, and you're betting on the managers to add value, as opposed to betting on the markets, as we are with international equities and core fixed income.
With regard to the allocation of round 4, we also do have to consider in our analysis the fact that Scott was talking about this earlier. Short-staffed in hedge funds, currently going through implementation to the current target, right? So we have to have an overlay there too, in terms of how we size asset classes like hedge funds, what's possible in terms of implementation.
Andrew? Going back to what you said earlier, you know, that our discussion on hedge funds really isn't centered on the return because it's kind of negligible, just a few points, and it's really about these other factors. I think to kind of refine my earlier request from the beginning of the meeting, it might be helpful to kind of refine the case for and against hedge funds relative to our experience with hedge funds. You know, on the fees, on the performance, you know, with the composition of the hedge fund portfolio, the strategy we're putting in play. Is that strategy projected to do any better moving forward? Is there a different composition that might actually produce a better outcome for us? I think understanding that much better to the experience of the last couple of years will inform our discussion instead of, because it's such a, it could become a very heated conversation. And we're really talking in the abstract here. We're just talking about numbers on the paper. And we're talking about generic pros and cons, for and against, based on projections. But really understanding how those projections and how those assumptions relate to our experience, especially on the concerns that have been raised on the table regarding hedge funds and some of the cons that you identified, clearly there are more. I think will help inform the discussion and refining it a lot more so we actually know what we're talking about and we can make a much more informed decision.
I'm sure we can do this, and I would just caution you, Andrew, that we have a very short time period that we've been invested in hedge funds, and so it's we would be careful not to take the actual results too much out of context.
Sure, but I think that can be kind of built into the analysis as well. I think we all understand that that's part of the factor, but knowing what we're talking about based on how we've experienced it, I think is going to be much more helpful than just talking about fees generically or different strategies generically.
Yeah, so for instance, I mean, this is, it wouldn't be a scientific study, but if you look at the mix of hedge funds we have, and you were to go back and say, let's assume we didn't invest in them, you know, as late as we did, but we owned them through a full cycle, looking at the way these specific hedge funds perform, or hedge funds like them that Callan's familiar with, we could show, you know, what the mix has done during a longer period of time, which might give you more understanding of what the future might look like based on a longer term past.
Sure, and I think also incorporating some of like the fee conversation into that as well. So the actual effect that it's had will help inform our analysis, at least my analysis. Yeah. I'm sure.
And these are, just to be clear, these are all their forecasts. Our actual, it's all net of fees, net of all these high fees. Yeah.
Right. No, so yeah, man, I get that. Given the time horizon we've been in hedge funds, they're wary about using that as indicative going forward because it just isn't a long enough period relative to market cycles.
Or a positive, right? I mean,
Positive.
I wouldn't take too much away from a short track record, whether it was positive or negative.
No, absolutely, but I guess, you know, what's good about this conversation is that it's drifted into the realm of strategies that are specific and suitable to our fund, right? We're an institutional investor, but we're not a foundation, we're not an insurance company, right? So if we're gonna talk about hedge funds, you know, less it's an asset class, but more of strategies that make sense for us, given the affordability context going forward. Because yeah, you can do the projections net of fees, but the reality is, you know, we're still suffering from that hangover, the fact that active management gains almost all wiped out in fees over the last over a 10-year look back. Right? So given that frustration, if we're going to have a real conversation about if we do hedge funds, how would we do them if we do them at all? There should be more in the presentation about, again, given the nature of a strategy that makes sense for our fund going forward, and none of that's really happening here. And relative to the affordability issues, right? Because yeah, we could go to emerging markets, and yeah, it's volatile, but so are hedge funds, right? You're hedging against other positions, but at least it's cheaper volatility. Because either way, we're buying volatility. So that's what I guess I found a little problematic about what we have here. And it's fine that, you know, the way we've moved thus far in hedge funds has been less market correlated because we're not doing as much long short, and that's fine. But if we're going to go forward, then the question would be, what are the strategies that make sense given our risk tolerances, given our funding situation? Unfortunately, we're not New Jersey, yay, but that doesn't mean we're funded where we should be. And you know, the city's doing well now, right? The city may not be doing well 5 years from now. Larry?
Yeah, I'm trying to find the right time to ask. I guess we're talking hedge funds, so this is the right time. Just to continue what Andrew and Susanna said about the to-do list, one of the real criticisms I know on hedge funds has been what data are you using to compare what reasonable expectations are. And you know, the comparisons you use to the HFMRI has been criticized because they have survivor bias. You talk about theoretically NYCERS should be able to access the best hedge funds in, you know, in the different assets, but that hasn't traditionally been the case necessarily. It's hard to say with a short track record, but it's a theoretical, all of this, you know, a lot of this. The best managers, the ones that are doing really, really well, necessarily do not want to do business with a public fund, not necessarily NYCERS, some particularly NYCERS because of the city's bureaucracy and contracting, and because we question fees and all those other wonderful things, and we care about some of the negative things that they do, and therefore it isn't always an easy place. So if you were to extract out those funds that don't do public funds at all, you know, those that just have high fees to a point where this board would never agree, if you were to, you know, X out of the HFRI, those that have been done really, really well, maybe 5 years ago, but when some hedge fund managers do incredibly well, they tend to, you know, go sit on the beach somewhere right now where it's freezing in New York, and they're not focused on their current clients. So it's really hard to say, this is what we will buy. It's an academic exercise is what happened if you were to pick those that survived the really bad process, and then we would access the best managers. And that just seems to me like buying a lot of theoretical mitigation of risk. Well, we're looking at real opportunities, perhaps in other ways in your other allocations, to mitigate some of that risk without all of these uncertainties. And I think that's the board's, you know, what we're trying to look at. I don't know if you have a response, but is there a way to do an additional analysis, I guess, on the HFI and what opportunities that we're looking at is the question.
Response?
I think we could do our best, but I think part of the conversation has to be with Jim Voss about specifically the portfolio here at NYCERS, as well as a lot of the direct hedge funds that we typically do not work with.
We hear you. Did you like a analysis of the sort of historical results relative to our opportunity set? So, for instance, you look at the two allocations we're looking at with or without hedge funds. What we would do here is to put more money into international equities and core fixed income, roughly a 50-50 mix. But you can compare, you know, how the hedge funds, both the actual hedge funds for the short period of time that we've been using them, and a comparable mix of hedge funds looking over longer periods in the past. We rely on Jim Voss to help us with that. How have we done so you can get a sense of what the history has looked like for this choice that you're about to make going forward? And we'll talk to both Cal and Axia to put together an analysis that would get you what I believe you're asking for.
Cameron?
I guess this exercise on hedge fund is sort of like the exercise of projected budget versus actual budget. And I know that this is, hindsight is 20/20, so we're trying to do the best that we can within the various assets to meet or exceed the expectation. But it seems to me that an asset allocation, which although is 4% to your comment, not negligible in a nearly $60 billion portfolio, that has performed poorly, in my opinion, has very high fees, and has really not been stellar at any time, and doesn't have has those concerns that I think we've heard, the lack of disclosure, the risk of that associated with that, with questionable investment practice, that we're having all this discussion about it, because, well, if we decide not to do it, well, there's risk associated with moving whatever that 4% into another asset. It seems to me that there's an awful lot of discussions taking place, and obviously I'm part of this, about hedge funds, for something that seems to have not proven itself, again, in my opinion, in the time that we're here. What I would like to see moving forward, since we're not going to make a decision here, is if there is a prospect of disinvestment or in that asset allocation, the risk that you mentioned about some of the places where we could, in fact, invest in lieu of hedge fund, I like to see that. I like to see it because your comment earlier about the return being a mix between bonds and private equity could run the gamut, right? And this idea that perhaps there are other ways that we can do and perform better and not have the risk and not have all of the other concerns that we raised before, to me, would be a valuable exercise moving forward.
Thanks, Henry. And I think it's a good point because we're not getting rid of risk. We're taking on different risks, and to understand those different risks and how they played out through history, I think that would be valuable. So we'll certainly do that analysis. One of the things I want to make sure that we get to is translating the risk of these various portfolio options into something that really is useful and very specific to New York City, to raise a point. And Sherry's prepared an analysis that's a tag-on analysis to count that I think would be something that we should go through. We're doing this with each of the boards, and I think it gives a real sense for what does a standard deviation really mean to the city to help you understand the return. So why don't we turn it over to...
Well, we still have a couple more questions.
I'm sorry, I thought we were done with the question.
Yeah. We're focusing a lot on hedge funds, which is one of the alternatives, and I was wondering why we're not discussing the other alternatives whose fees are pretty much the same, the private equity, real estate, infrastructure. And is there an answer to that one? Why we're not looking at that the same way?
Yeah, so what we try to do, because there's a general concern about the high fees of alternative asset classes.
Yeah.
And what are we getting for that high fees? And this actually leads, when you're done with the question of hedge funds, this leads directly into Sherry's analysis. So when you look at the low-cost alternative, it says we're not going to do any alternative investing. No asset classes where there are high fees and carry. No private equity. No infrastructure. No private real estate. No hedge funds. No opportunistic fixed income. What if we banned those from the portfolio? Then what would the optimal risk look like, and what would the portfolio look like if we get this in order to get to 7%? And as you can see from the analysis that Jim showed you, you can get to 7%, but with a lot more risk. Rather than 13.8% risk, you're over 15% risk. Well, what does that mean? What's the 13 and 15 means? This is what Sherry's analysis is going to say when you're ready.
Right?
Just quickly, I think Larry raised a good point that you should get more information on in terms of, and again, the hedge fund issue about the real difficulties in benchmarking the asset class, given the strong survivorship issues. You know, yes, looking at slide 23, you're seeing more and more assets moving into the hedge fund space, but the reality is, from what I've seen from trustee training, is that it's really only a small pocket of performers that are generating most of the growth. All right, so I would like some more edification or education on the benchmark issues around hedge fund, which are the ones that are doing well or have them through market cycles, to inform any sort of strategies discussions going forward.
Okay, so we're ready to hear from Sherry about the contribution. Take it away, Sherry.
Thank you. Let's turn to, there's quite a few numbers and things here. So let's turn to Callie's presentation on page 5 first. So I just want to give you a high-level understanding of the information that's in front of you. As Scott said, my job, my portion of this project was to translate the asset portfolios and asset mixes to something more understandable for you. And so my office did an analysis of these various asset mixes and what they need in terms of the change in the contribution.
Sherry, it's a little hard to hear you. Can you talk into the microphone?
So my portion of the analysis was to translate these numbers to something more understandable for the board, and I've done it. My office has done it in the sense that we're showing you the change in the contribution over the next 10 years based on these portfolios. So there's a lot, probably 15 or 20 portfolios that we looked at, but if you turn to page 5, there are 5 asset mixes here, and I was asked to cost out the left 2 and the right 2, so all of them, but for 50% long-term 3. So these are the asset mixes, and their returns are sprinkled throughout this presentation, but if you look at the page that was handed out, the color copy, those summarize the returns for these 4 portfolios. Yes.
Yeah. So now, what do you get that? John's got some.
What you guys.
Is there anybody else that doesn't have one? It's like a green. Okay.
Right. So these were the returns that Callan had provided to me. So just that we understand what we're looking at here. On the handout, there's a current target column on the left. And the 17.8% represents the best case scenario, which we call the 95th percentile, but we had said that we refer to as the 5th percentile. And the mean case, the expected case would be the 6.8% return on a per year basis. And the worst case would be the negative 3.3%. So what my office did was we took these returns for 5 years, 17.8%, that's the way that case for 5 years. And we extended the analysis to 10 years because the asset valuation methodology is based off of the 6-year smoothing. We take the returns in market and we smooth it over 6 years to have a more smooth actual value of assets. So for the subsequent 5 years, years 6 through 10, we use our assumed rate of 7%. And then if you turn to the other handout, which is the black and white one, those are the results. So you will see, analogous to that scenario, is the negative 61.1%. What that means is, in the next 10 years, the contribution is going to decrease by approximately 61% if we were to incur the 17.8% return for 5 years and then 7% thereafter.
Contribution by the employer or?
The employer contribution, correct. So this is off the baseline. The baseline scenario is just the flat 7% for the next 10 years, and that yields approximately $33 billion in contribution. So,
Wait, what? I'm sorry?
I'm sorry, $33 billion in contribution for a 10-year cumulative. So that was.
Your current plan is that the
Right,
city
if we
will
were
kick
to
in
incur
$33 billion
7%.
over the next 10 years towards the plan, and everything
Right.
from that is from that baseline. So plus 1% would be 1% more than the 33 billion, minus 1% would be 1% less than 33 billion.
Right.
Sherry, in the case of NYCERS, is that just the city of New York's contribution, or is that all the NYCERS employers' contributions?
That's total.
So it includes MTA and...
Yes.
Okay.
So if we looked at just, another portfolio, the baseline portfolio, which is baseline 3, it's summarized on page 5, but if you wanted to flip to page 12, it gives a little bit more information about the returns. It's baseline 3, it's in approximately the middle column, which is the same, this is the same as the handout, the color copy handout that was given to you. So the 18.2% represents the best case scenario, and if we incurred an 18.2% return for the next 5 years, and then our actual rate, assumed rate thereafter, then the contributions would decrease by 62% approximately after 10 years. In the worst case scenario of the baseline, we would, Callan had simulated a negative 3.3% return, which is approximately 10.3% underneath our baseline of 7%. That would generate a 54.6% increase in the contributions after 10 years. So that's how to read the handout that were provided to you. I'm not going to go through all the numbers and all the scenario and asset mixes, because I think that once you know how to read one, you'll understand the other. But if there are any questions, I'd be happy to answer. Yes.
Yeah, it's kind of a global question. So if I'm reading this correctly, essentially the difference between the worst case scenario of our current policy and the worst case scenario of, let's say, based on that hedge funds or the low cost portfolio is essentially what $2 billion over the next 10 years. So essentially around that, right? Just you're thinking 55% for the current policy, 60%, 55% of the $33 billion. So around $2 billion of essentially about $20 billion difference between the worst case scenarios of all of not versus the baseline. No, I don't mean versus the mean. I mean versus, let's say, the worst case scenario of current policy, worst case scenario of baseline, worst case scenario of baseline without hedge funds, and the worst case scenario without the low cost return.
So let me try to restate and answer your question at the same time. If I incorrectly answer your question, let me know. So if we look at the worst case scenario for the current policy target, we're saying that if we incurred a negative 3.3% return over the next 5 years, our contributions would go up by 55% approximately. So that is, instead of $33 billion, it would be approximately $50 billion. So that's about a $20 billion increase.
Increase from the mean outcome, correct?
Right, from if we were to incur 7% for the next 10 years and all actual assumptions were met.
Absolutely. So what I was saying was more along like comparing every portfolio's worst case scenario.
Okay.
So
Yes.
and so that 5% would be essentially $2 billion.
Right, because you're saying between the 60.2%
Yes.
and the 54.6%. Yes.
And so then essentially, and this is not just research, but I guess everybody at the front, essentially we're getting $2 billion of protection in the worst case scenario for about $1 billion of extra fees, right, over the years. I imagine that, so you said that the difference between the low cost portfolio and the kind of the ones with alternatives was about a 50% difference, so 100 million versus say 200 million or something of that nature. And so I'm trying to frame it on mind. Essentially, we're buying $2 billion of downside protection for the $1 billion of extra fees. Around two, like approximately. Okay.
Correct, but your fees are included in the returns, so they're not deducted from the returns. But you could go with a lower cost alternative, and it would be 5 or 6% more downside. Also, about 3% more upside. Right? So it's just riskier. Same expected return, back to Pat's question. So with alternatives, about 6% less downside, 3% less upside than with the no alternatives portfolio. So you're getting the same return expected with more risk without alternatives. So what are alternatives doing? Not just hedge funds, but private equity and infrastructure and everything else. They're lowering the risk for a given level return. That's the bottom line, and you know, as Antonio just put out, $2 billion in the downside holds in the balance, and it's a $1 billion something on the upside. So it's just the question, and this is a question that Callan can't answer, that BAM can't answer, that only the trustees can answer. You know, from your perspective as fiduciaries, how much risk are you willing to take? The expected returns are the same, but the question is how much risk are you willing to take? And yes, there are lower fees associated with the more risky environment. But again, the fees are already taken out of the returns.
I understand that the fees are taken out of the returns, this is also goal, but the fees that we pay are the $100 million still earns the return that, and so I was wondering if that's incorporated in either this analysis or the analysis of the portfolio. Essentially, the extra $100 million a year would be earning the expected return of 6%, 7%, what have you, and how much of the gap does that close? Essentially, I guess the question that comes out of that, and I don't know the answer to that, but that's more of a, perhaps we can see that later.
Is it fair to get a sense or ask a question about the opportunity cost of reinvesting the would-be savings?
Oh, that's right? Yeah, that's the question. That's right.
I have a question. The $33 million contributions, I assume employer contribution, is for a 10-year period.
Correct.
And that's for all 5 systems?
No, just for NYCERS.
Just NYCERS, okay. So
It's
the
billion,
assumption,
$33 billion.
yeah, so the assumption is the better you make, obviously, the less of that contribution you have to.
Right, so, for example, the best case scenario, when you're earning 17.8% in return, that's higher than our 7% assumed return.
Right. So
because we're earning higher, we need to pay in less. So that's why the contribution reduces by 61%.
Okay, so then the question is, and that takes into consideration all the new mortality tables and everything.
It's going to be the same because what you're doing, the 61% is the case of comparison between whatever the baseline is and whatever these returns will generate. So whether you apply these on a basis of with mortality or without, it's going to be pretty similar. Because if you start from a higher base, you're also, your returns will be a higher base as well.
So you're assuming a 10-year flat, basically, nothing else changes.
Right.
Right, so with the same number of employees,
right,
same ratio, everything, that's what I'm asking, yes, over a 10-year period.
Yes.
Yeah. Is there a reason why you have did the 5-year horizon with 1 set of expected return and then the last 5 years at the 7?
Well, we started this analysis with a 5-year return, but through internal discussions that we had, because the asset valuation methodology smooths in gains and losses over a 6-year period, to really reflect the whole gamut of the effect of what the gains and losses will do to the contributions, we looked at a 10-year horizon.
But why not use the same, because the expected returns from the Callan asset allocation, they're a 10-year horizon expected return.
If we use 10 years of 17.8%, you won't be capturing years 4 through 10, or 6 through 10, because those gains and losses don't get phased in until 6 years, fully phased in until 6 years occurs.
Oh, I see. So then you want to have 0 gains and losses in the last 2 years.
Correct.
Yeah, you just assumed the 7% return in the last 5 years.
Henry. Just to comment, I think that rather than for us as fiduciaries be scared about the prospect of the $33 billion, it's much more to the common domain of an opportunity to kind of have a fresh look at this investment and say, look, you know, there is a tolerance for risk, but within that risk, we're all trying to make the best possible decision. We've had a lot of discussion about a particular asset allocation, but I do think that we cannot, for any reason, devoid the politics out of this, in the sense that, you know, there'd be new tiers set up that's supposed to lower the cost, and all of that stuff. So as an exercise, I think this is our opportunity to look at assets that we can do better. We can do better than the top, what we've been doing, and we need to start. You know, I don't think it's necessary to take any risk. I think it's reassessing our risk as we go forward. And I think this is an opportunity for us to say we can absolutely reduce this $33 billion number by having a different way of looking at the investment. This is not a criticism of BAM or what you're doing. You've inherited most of the stuff. You've done the best that you can. I have full confidence with the staff that you have. But I have to say, you know, I think we cannot miss this opportunity, given the risk and given the potential on the investment that has to be made in the contribution.
Just to be clear, with the analysis and the framework for the analysis, if you wanted, as you said, to be absolutely, you know, have an expectation that you could reduce the $33 billion, you know, over the next 10 years, you would have to have an expected return above 7%. So you'd have to take more risk. So you would have to. We were playing around with the dial number 3 in the riskiness, and you have to go further out on the riskiness, and so your out scenarios would have higher upside and higher downside. But to get the middle scenario, the 0, we would have to shoot for more than Sherry's 7% expected return. That would be the way to execute what you're suggesting.
I guess my point is that's void of public policy change. So as people pass away in the system, a new tier for pension, for instance, comes into effect, then that amount of $33 billion could change. Is that not the case, Jerry? Up or down? You know, if you enhance benefit, obviously the number goes up. If you create more of the, you know, or the demographics change or people die, that number comes down over a 10-year period. So I understand the analysis moving from 5 to 10 from an investment point of view, but also from the investment of lowering the liability. There's also another, which it's unknown, but there's also a possibility of that number going down based on changes that have been made legislatively and could be made legislatively.
That's another discussion. This is obviously building something else at this time.
So speaking in terms of taking risk or not taking risk, do you feel, as the subject matter expert, whether the next 10 years, should we take less risk or should we take more, the same amount of risk or more risk in terms of asset allocation? How do you feel in terms of the prospects of the U.S. Capital financial markets? Do you have a view on that?
Well, based on our expectations, in order to achieve the same level of return that you expected 5 years ago, you are taking more risk because our expectations are lower.
Okay. So in order to achieve the same targeted return, you do need to take more risk.
That's correct. That's right. And that's consistent across all consultants, across all market observers to whom I'm familiar. That is part of the current environment, that if you want to get the same returns that you've enjoyed in the past, you're going to have to take more risk with the expected returns going forward. Just look at the fact that you're getting paid nothing for cash today, and all the returns get built on that. And if in a normal environment we're getting paid 2% or so for cash, the nominal expected return is down 2% for starters.
But you are, built into your expectations is an inflation rate of 2.25%. So you are expecting that, you know, because we haven't had 2.25% inflation I don't know for how many years at this point.
And in addition to that, we're building into the expectations higher yields too. So while we say that the fixed income return, let's say for core fixed income is 3%, it's not 3% a year for each year of the next 10 years. It's lower on the front end, and then as yields rise, it's higher on the back end.
And I want to ask another question about the expectations on page 6. Essentially, you are predicting a 10-year geometric return for private equity of 90 basis points over public equity. Our benchmark is 300 basis points. And you're also, for that 90 basis points of increased return, the standard deviation is about, what, 40% higher, so 30, almost 33%, 18% for large cap.
Well, it's double the equity, it's double the equity deviation, basically.
Yeah. Yeah, I mean, it's, what we're trying to do with private equity is we're trying to integrate it in what is really a time-weighted rate of return environment. And so in terms of looking at your projected spread, it's probably better to look at the one-year arithmetic return and look at that spread, which is, I think, more on the order, it's not quite 400 basis points.
Can you explain why that is?
Well, the reason is that when you look at private equity returns, you're looking at an internal rate of return as opposed to a time-weighted rate of return. The other thing is that the private equity investments are not publicly traded investments, so we are not getting the same data frequency that we are for the publicly traded investments, and therefore your experience standard deviation is substantially lower than it would be if these investments were publicly traded. So what we try to do with the standard deviation is say, how do we come up with a standard deviation that truly reflects the risk of loss in each of these investments? So this is true not only for private equity, but for example, for real estate. Your experience volatility in real estate is not likely to be 16%, it's more likely to be 5 or 6%. But if you use that, and this is probably a number that people are more familiar with, if you use the real estate standard deviation of 5%, you would have said that the losses that were experienced in 2009 and going back to, let's say, 1990, 1991, would have been like 8 or 9 standard deviation events. So we have this compromise that we have to make between the standard deviation that you would realize recognizing that these investments are essentially appraisal driven in terms of their volatility, and the conflict that has with regard to how much they could actually lose. Does that make sense?
He has to hop up the standard deviation number in order for it to make sense and for it to be comparable with the public asset classes, because the actual deviation of the appraised values is not reflective of the underlying volatility in transaction prices if these things traded all the time.
And the liquidity associated with those investments.
Yeah, so they have to artificially, very carefully with a lot of thinking and models, but they have to artificially boost the standard deviation of private equities and real estate. If they didn't boost the standard deviation of real estate, the optimizer would try to put about 50% of the portfolio in.
And also, I mean, two things. As I say, let's take 2009. I'm throwing out a round number. Real estate, some real estate sectors were down 40%. If you had a 5% standard deviation and a 6% rate of return, you know, that's what, like an 8 or 9 standard deviation event. And we think we've, over the last 30 years, have experienced those types of losses twice. So that doesn't seem to the potential for loss wouldn't seem to jibe with a 5% standard deviation. The other aspect, well, I think I just probably repeat what I just said, so I'll leave it at that.
This may be a completely stupid question. This is maybe a reflection of just lack of experience here, but anyway, is it at all prudent to consider, and I recognize that this suggestion might have other financial implications, is the 7% rate of return a prudently reasonable assumption now? And should this exercise, even if we stay with the 7% return, projected return, should this exercise in asset allocation consider alternative, potentially lower rates across all the proposed mixes? So we haven't seen that yet. I mean, and that obviously has financial implications, but should that be part of the analysis in any way?
First of all, it's not a stupid question at all. But,
yeah, and then there are two different questions, as I see it. One is, what should the long-term expected rate of return be? And that's for your actuary to decide. The second is that, as I've mentioned, you know, there are different time frames for strategic asset allocation and for actuarial calculations. And we have run across a number of clients who say, you know what, at 7% expected rate of return for 30 years, yeah, we'll get that. As Sherry mentioned, you know, our expected rate of return for 30 years is higher than it is for the next 10 years. And so consequently, what we'll do is we think that the risks of the market are such that we're not being compensated for the risk that we're taking on. We're going to have a more conservative investment policy. And we are, with a 7% expected rate of return, let's say, going to target 6.75%, because we think that the risks associated with the portfolio are not being compensated in the current market, with the idea that 5 or 7 or 10 years from now, we're going to make the portfolio more aggressive when those risks are compensated, and on average, we're going to make at least our actual rate of return. So it's not only feasible to look at reducing the risk of the portfolio, it's been done by other people that we work with.
If you look on page 9, right, base 1 and base 2 are examples of that.
Yeah, and people have implemented those lower risk portfolios even though they have a higher actuarial expected rate of return.
North Carolina is a system that's been very public about their desire to do that. They're simply not, you know, reaching for their long-term actuarial expected rate of return for just the reasons that Jim articulated.
Well, I guess, and this might be a question for the board, I guess, at what point should we be considering these, you know, we have 5 different options here on page 9. At what point does that analysis, does that factor into our conversation to consider the ultimate proposal that you guys are bringing to us? When do we start talking about that? Or should we start talking about that?
Well, you know, I think we would be receptive to your thoughts about that now. You ultimately are the ones who express a risk preference. You ultimately are the ones who tell us how much risk you're comfortable in taking. It's Jim and Bud and Callan's job to try to translate that risk preference into some potential portfolios with our counsel and Sherry's counsel, and then for BAM to go about the process of implementing them. But it's not at all a stupid question. It's a very insightful question, and one that the board, you know, I would encourage you to look at, because we are in a time, back to the question that came from the back of the house, we are at a time where expected returns are lower. And so to get the same nominal returns that we would expect over very long periods of time, we have to take more risk. It's a dangerous time to take more risk. And so it's not illogical at all to say, you know what, we're going to stick with the typical level of risk that we've taken in the past and just deal with the fact that they're lower returns for the next 5 years or so.
And you could repeat this exercise that we have here and say, if we have a 6 3/4% rate of return, recognize that as a lower standard deviation, how much could we potentially save in a 5% worst case scenario in terms of contribution?
To the last part, how much do you potentially save?
So if you have a 6 3/4, if you move to arbitrarily base mix 2, you've got a 6 0.75% expected rate of return. That's going to increase your contributions in the mean outcome expected case on the black and white handout by some amount that the actuary can determine. It's also by virtue of the fact that it has only a 12.55 standard deviation, it's going to reduce the amount that the contribution increases in the 5% worst case scenario. So those would be dollar values that you could use to say that, you know, over the next 5 years, we might have a higher contribution in the expected case, with the idea that because some markets are you know, relatively risky, we want to protect from having a very large contribution on the downside.
The same kind of trade-off that we're talking about, low cost versus high cost asset allocation. It's a risk-reward trade-off. And it'd be very easy for us to conduct such a study. It's already basically laid out. If you'd like to see something like that, so that it helps you to assess you know, what the trade-off would be between the expected return and the outsized cases, we could do that, you know, quickly for you. So it's up to you.
So, Callan, you were around for the last one. You know, this is often been presented as, you know, here's our current mix and here's the current return and current standard deviation. What was the standard deviation like when we did this the last time? Like essentially with this asset mix, you know, right now it's this 13.55% standard deviation. Was this same asset mix at some point 12 or kind of as our starting point for this will essentially we assessed our risk at the last time we did this. And so, you know, here's a portfolio that looks at like this with regard to risk now versus this is what the return that will be generated by a portfolio that looks like this now. I don't know if that's something that we could kind of get a sense of, you know, this is what, you know, this was our risk tolerance before essentially, and so are we still comfortable with this risk tolerance as the starting point versus our portfolio as the starting point?
I think that's a very interesting question, and I can tell you that the volatility that we have for example, equity now is, you know, borders on the highest volatility we've ever forecasted for equity. Oftentimes, for example, the S&P 500, which now has a volatility of close to 18%. In more normal markets, it's probably closer to 16. So we are in more volatile times.
So we can get you a copy of the last one.
Yeah, I think that would be I think that'd be a great starting point for us to then kind of assess, you know, where we are now, because that's essentially the one that was at least the previous people who looked at this before and had many of the same concerns that we have now as their baseline.
So rather than give you the same mix, we would give you the same standard deviation.
Yes, and like here's
12.65 last time. What does that give us today?
Mm-hmm.
Correct me if I'm wrong, but the last time that you did the asset allocation, wasn't the expected rate of return still 8%? It hasn't yet been changed.
2012.
I think it was right around that time.
But I think the rate at the time of the asset allocation was still at a higher rate, I believe. Doris, am I right?
I think you are correct, but I don't have it in front of me, but that sounds accurate.
It sounds right to me.
It sounds right, then that's correct.
Please, right.
We've been here at events for a while, and we did a lot of time on hedge fund. Going through the presentation, I feel like I would like more information on the cost effectiveness of you know, real estate infrastructure. You know, we're going to talk about, you know, being compensated for the risk and where we've got to take risk to meet our goals. I would like some more information in terms of the, you know, net of fees. Where do we think, you know, more than, I mean, some of the stuff here is somewhat helpful, but given that we're still early in our infrastructure portfolio, you know, the pros and cons of either being more aggressive or less aggressive in those in infrastructure and real estate.
So you want more information on the costs, the fees associated with the other alternative asset classes?
Yes, please.
Okay.
Particularly real estate infrastructure.
Yeah, and so, I mean, one way to calibrate this, I just want to make sure I'm being responsive. If we were to take Callan's expected returns for those asset classes, and then map them to the fee structures of our managers, you know, we can calculate what would the fees be if we achieved the expected returns that Callan's expecting. It would be one way to give you a number. Because remember, the fees vary depending on the returns generated.
Right.
And so we could kind of force it in a consistent way so that you could look at the real forecasted fees. That makes sense to you? Yeah. Okay, we'll do that.
And in the appendix of this presentation that we could cover now, or you could look at it at your leisure, is how we came up with our expectations for these asset classes.
Let me take the temperature of the group. Do folks want to hear Alan's explanation of how they came up with the in the appendix, or are people not?
Happily, but I want to know what everyone else.
Get the quick version?
Quick version?
Well, let me ask this. Are there specific asset classes that you're interested in? Because we did the hedge funds, I don't remember all the
Infrastructure.
Yeah, infrastructure bank loans, which were did not enter into the allocation, opportunistic fixed income.
Well, since the question was asked, why don't we do it?
Sure.
All right, the way that we approach this, and that would be on slide 33, is that we got some information from BAM in terms of how the asset classes were implemented. We also took into account what the benchmarks were, and then tried to translate that into expected rates of return. So on slide 33,
49.
That's hedge fund.
oh, I think you said hedge funds.
No, infrastructure.
I apologize.
Thank you. That'd be Henry.
Got hedge funds on my mind. Okay, so infrastructure,
49.
right, 49. So we looked at historical returns to come up, and this actually speaks to the projection process generally, if a little bit superficially. You know, we look at historical returns and say, well, what's in the realm of possibility? What's the range of returns historically, so we make sure we don't come up with a return that's outside of that historical time horizon. Unfortunately, with infrastructure, you have a very short time horizon for most of the indices. And also, this gets back to the issue of, private investments versus publicly traded. So there are publicly traded infrastructure investments, and that's what we used, and then we recognize that also there's a debt aspect to this. So we had 50% publicly traded and 50% in corporate bonds to come up with a range of historical returns. And we wanted to do that not only on an absolute basis, which is what's done on 49, but on a basis relative to cash. And that reflects not only the underlying risk-free investment, but it also has an inflation component to it. And so we wanted to take into account the fact that we are in a low inflation environment. So if we look at infrastructure on slide 50 over the last 10 years, it's had about a 6% premium over cash. The other aspect of this is the risk associated with it. And you can see that the volatility over time of this proxy for infrastructure has averaged about 9.33%. One of the things that we don't like to do is we don't like to be either overly conservative or overly aggressive in terms of the volatility. Now, if we look at the most recent volatility, we have an input of on the order of 6%. And while that may be what the market's experiencing now, we want to take into account the fact that it can be substantially more volatile than that. Probably not as volatile as what we saw in the financial crisis, because that was an extreme event. So we just took that 10-year average. The third thing that we looked at is on slide 52. and that's the Sharpe ratio, which was alluded to earlier in the discussion. And what that is that's the expected rate of return, net of the risk-free rate, and divided by the risk, or divided by the standard deviation. And the idea is netting out the risk-free rate is that the manager or the portfolio should only be credited with the extra return that is taken over and above what can be earned without any risk, and then to see if that investment is being properly compensated for the risk that's being taken. You divide by the standard deviation, you get the Sharpe ratio. And what this does at 0.76 is it gives us kind of a guide to, do we have the ratio of returns to risk approximately right? And so if we move on to slide 53, we came up with a projected risk that's about 9.5%, which is just over the 9.33 that's been experienced on average. The projected return is 8.25%, which is that 6% return in excess of cash that we saw in the earlier slide, plus our cash expectation of 2.25%. So that adds up to 8.25%. Now, to kind of confirm that we have that right ratio, we take out the cash return and we divide it by the expected standard deviation of 9.5%, come up with a Sharpe ratio of 0.63, a little bit less than a 0.76, which is consistent with our attempt to be modestly on the conservative side of our capital market expectations. That's kind of a thumbnail sketch of the kind of macroeconomic view of this. In fact, with infrastructure, we have subject area experts in the firm that we talked to and said these numbers seem reasonable. They gave us more detail. We kind of confirmed this, but this is the economic analysis. In short order.
We use a similar exercise for the other asset classes.
That's correct. I know we're limited on time, so I don't want to, say too much, but to be fair, because I said this about the hedge funds, there's also, we've been very supportive of infrastructure. I think there's a good case, reasons for that. But the data set, opportunity set, this is not distinguishing direct invests like buying an airport, buying an Ontario system versus a fund versus energy versus the greenfield, brownfield type investments. This is just as a class. It doesn't necessarily mean we have access to this.
This is very much like the comments that we made with regard to fixed income earlier. We want to say about how much infrastructure is right, about how much opportunistic fixed income is right. Once you decide that it's 1.5% in infrastructure and not 5 and not 0, then you go in and say brownfield, greenfield. Yeah.
And this is all publicly available, so everything you model here, we could buy in the marketplace. And of course, for the fancy fees that we pay managers, we would expect excess returns when we go and buy airports and pipelines and so forth. That's not forecasted in the model, it's just the public equivalent that's in the model.
So all these are reasonably able to be attained, and then the extra returns will be generated by the manager.
Yeah, and so any value added from the manager for the fees, extra return for the fees, is not incorporated in the assumption. So for an asset allocation assumption, we're assuming we take the manager fees and throw them in the ocean, that they're not getting us any extra return, largely speaking. And you need to keep that into consideration when you're looking at things like alternatives or no alternatives.
Great, thank you.
Okay. Leanne, did you have a question?
Yeah, I was wondering, following on Larry's question, is how is the infrastructure asset allocated? Is it a separate account managed by a specialty manager, or is it a commingled fund?
You're talking about our investments?
Yeah, the NYCERS.
Yeah, so we have several different funds that we're invested in that are managed separately by third-party managers, and they are for the most part limited partnership structures that we're in.
So GPLP.
Correct.
So similar to.
Correct, but what he's modeled here is publicly traded to get the risk and reward rate.
Yes, I understand. Okay, thank you.
Any other questions for today? Alvin?
I was just thinking in terms of the past manager presentations, I don't think of one who has presented to us that's come with an IRR net of fees less than even like 16% or something, 18, some even say 24. Now, are those days long gone now in terms of the people that I guess are going to be before us in the next year or two? Or those rates we could still expect to receive those IRRs?
All our managers are from Lake Wobegon. They tend to have optimistic numbers, and we tend to have very sober numbers when we do asset allocation. So I think you can say in general that the managers' hopes, and particularly in the private equity, the LP structures, they're shooting for large returns. But I will say this, that the amounts that they build into their expectations, the amounts that they're shooting for, have come down with the expected return environment. So they've always been high relative to the types of numbers that you would get in an asset allocation exercise, but they're lower than they were 5 years ago.
And in the sizing that Callan does, we're also looking at what's implementable for infrastructure. NYCERS has only done a handful of infrastructure funds to date, very few. And so when we look at this, infrastructure actually looks relatively attractive, but what's implementable is quite small on the asset base of NYCERS.
Okay. So I think we're just about done here. I just wanted to ask, so where do we go from here? Next step.
I would suggest that we come back with the analysis that Andrew mentioned, which would show, and the analysis that Antonio mentioned, which would be two different ways of kind of calibrating different risk trade-offs for the portfolio. Give you guys some time to think about the hedge funds, no hedge funds, alternatives, no alternatives, trade-offs that we've articulated here. We would use the same rubric that we use today to look at these two new portfolios. And then you would then have two additional ways of looking at risk and return. And hopefully the next discussion could come to some sort of consensus about how much risk you'd like to shoot for, and then how you would like to shoot for it, right? So you could either reduce the overall mix to shoot for 6.5 or 6.75, or you could go with more alternatives in the portfolio in order to reduce risk. Your choice. And so we'll lay that out for you. We'll do the low cost and the high cost, both through the lens of the last standard deviation and through the lens of lower expected returns, so you can see the relative trade-offs. Does that make sense, John?
Yeah, I think it does. I also think the discussion that you mentioned about long treasuries versus non-long treasuries would be useful for those who want to attend.
What I would suggest, that is going to be an extremely technical discussion. For those of you with a stomach for that, you're welcome to come and listen to that discussion. I would suggest for this group and for the other boards that we come back with a summary of the discussion and BAM's recommendation.
But what I'm saying is that
you'll all receive an invitation. Anybody wants to sit in.
right. So, but it seems like that discussion needs to take place before we try to come back together at this point.
Yeah, there's a multi-board timing thing that I've got. So Wilshire and Rogers Casey are trying to catch up with Callan and Roquetan and NAPC because they just got started last month. And I need them to get to the same places we're at today before I can bring their gyms into debate long treasuries. So I'm not sure which you'd rather do first. I think here the long treasury argument is kind of a subsequent decision. As you can see from Jim's analysis, it through Callan's lens, it doesn't make a big difference in terms of the asset allocations that we might choose. The riskiness, that's a board decision, that you all can weigh in on separately. And so I would say that doesn't have to wait for the long-term bond discussion. That you could go ahead and have the subsequent discussion, and we actually can do the turnaround on the numbers. Both Callan and Sharon speaking for them, but for Beth, it's fairly quickly.
So should we try to, while everybody's still here, should we try to find a date?
Either for a special meeting, or maybe I can suggest piggybacking off the next regular meeting.
Diane, you go on piggyback?
Does anybody have the date on it? Next regular, Thursday.
March 10th.
March 10th is.
What is then somebody else?
You can't do it that.
No.
That would be mine.
I kind of feel like it's a bit like Catherine, given her experience. If we, I mean, especially if we think that we're potentially going to make a decision, then I don't want to do that without this right.
How about the 11th?
I can't do it, but I have to go on a local 237 trip with our retirees in Florida, so I can't be here on the 10th or the 11th. Also, it may be I'm the only one here who feels this way. I don't like taking up investments at the regular board meeting. It took a lot of time last time in the regular board meeting to address the investment issues that we discussed.
Does anybody care to suggest another date?
The 15th, 14th, following week?
Well, we have the CIM on the 16th.
The 16th is the
CIM.
meeting, right?
I mean, I think that would be, we might be preparing, the 14th.
Does the second work? Is that too soon? It's 2 weeks from today?
Which one?
The second? Is that too soon? You guys need more time?
Wednesday the second.
Wednesday the second?
1, 2.
Okay. Henry's not available.
That works for me. I don't know if it works for Ken.
Henry's not available. Is that?
There's a deferred compensation meeting that may affect some members of the board, but
There is on the second?
On the 3rd, there's teachers.
what's it say?
The 3rd or the 4th?
How about the
Third is
4th?
TRS.
How about the 4th? Friday the 4th? Is that too soon? Callan and,
As long as I get the numbers fairly soon.
Yeah, it's just, I mean, all we gotta do is the standard deviation from the last time, run the mix, share, run the numbers, and then the other one is, we run 675, you've already got the numbers for that. Yeah. March 4th?
oh, I'm sorry, the 4th is, you'll go in for, do you want to suggest a?
Actually, I won't be on March 4th,
Monday the 7th?
Yeah.
If we do Monday the 7th, could we maybe do the afternoon? So, Monday, I'm throwing out Monday, March 7th at 1.
There's a franchise concession meeting that day that some of us. Hearing. Yeah, it's a hearing. Did some of us sit on? I guess I alternate.
In the afternoon?
So.
Yeah, it's at 2:30, and there's 2 large-scale things. It's a public hearing, so.
We do it in the morning on the seventh?
No, we would have to move some.
Yeah, we can move right into the meeting.
all right, so.
Yeah, I can do the same.
I don't think she'll want, I think we could do the morning. So say morning.
So are we good with the morning of March 7th?
It's up to you if you want, if you want to be there, let us know.
Henry, you can't do the morning of March 7th?
I cannot do what's said.
Can I make a suggestion? Perhaps we can, Henry, your time here is incredibly valuable. It's up to you. But we could also defer the actual vote to the CIM and break out. So we can have this conversation and then ultimately have a further discussion of the implementation at the breakout session. Unless you believe there's too much to handle at the CIM breakout.
Do we still have a CIM meeting on the 16th?
Yes.
Yes.
For NYCERS?
Yes.
It's for everybody.
It's
Not,
quarterly
the 29th
It was the
29th
29th.
is not going to be here, but for the 16th, that's a 4 meeting.
Right. And you have a NYCERS only lunch that day, yeah, where you vote on the matters that are brought before the CIM.
Is that going to be enough time for us to discuss and vote in the breakout session, given that there's, we came back?
Full conversation on the 7th, discuss it with our principals, and then vote on the 16th with somewhat of a conversation.
I think the expectation would be if we have another special meeting, we would get a lot of the questions to Callan and to Dan. Be prepared to make a decision when you get to the next CIM.
We have not set it.
Okay, that's fine.
Okay, so, the 7th? Sorry? Okay, so I think we're okay for the morning of the 7th?
Okay. What time?
9:30?
Okay, so, NYCERS,
And then this would be another special.
And then you could take any votes on the 16th,
Or at another time.
or another.
Should we say start at 9, maybe we can start at 9:30?
well, I would say start at 9, but we don't seem to have a lot of success in getting quorum here at 9. I mean, can people say 9 o'clock?
Well, if we say 9, we'll actually start like at 9:20. If we're supposed to say 9:30, it's starting at 9:20. That's my thinking.
I'll have to come later.
I gotta come here too. I'm actually flying back.
So why don't we say 9:30 and try to make it 9:30?
It'll be better. I'm flying in from town that way.
So 9:30.
Yeah, I'm sure.
Okay. All right, now, I think we actually need a motion to adjourn.
I said, so in addition to what you said, Scott, when you said that things should prepare, we also asked for more refined analysis on the hedge funds for and against based on past experiences. So you want me to include that as part of what we get?
Yeah, I'll probably bring Jim Voss and Neil Messing here to go through that as well. Why don't we do this? Suzanne will send out an agenda for this, and we'll describe in some detail what we're talking about. And then if we're off a little bit with what you're expecting, we can make an adjustment. But it would be the more detailed historical analysis of our hedge fund portfolio and the risks there, and the performance and what it's done both actually and theoretically over the past. Secondly, if we did a mix based on the standard deviation from the last asset allocation, what would that look like today? And then finally, if we shot for 6.75% return, but rather than 7, what would the trade-off be between the low cost and the benchmark portfolio? Okay.
Given the fact the last asset allocation was done at an 8% target,
7.5.
there was no 7. There was no 7.
Okay, I said 8, and everyone shot me.
You zoomed down from 8 to 7. Right. I don't know that the standard deviation from that will be pretty good meaningful.
We'll take a look.
Just to be clear, this is not to take a vote.
No vote.
Set, right? And not.
Further discussion. If we're ready for a vote, we'll do it at the CIM on the 16th in the caucus, and if not, a meeting subsequently scheduled. Okay?
Right. And in any case, the vote would be to take one of the paths, not to do a final allocation, because we have to go back and
That's the important.
The past?
Yes.
Yeah, I understand.
All right. So is there a motion to adjourn?
Motion to adjourn.
And a second?
Second.
All in favor?
Second.
Well, there is one.
Was that one
All
in
in
the
favor,
show?
please say aye.
Aye.
Okay.